exam and joining us at CFA Society Nigeria. For more information, visit us at cfasocietyng.org. CFA Society Nigeria, making finance a force for good.
Hello, everybody. Good afternoon, good afternoon, good afternoon, or good morning, depending on where you are joining us from. We are all here at the second day of CFA Level 1 Vision Bootcamp. If you can hear me, please tell us your name in the comments and tell us when you are writing your exam so that we can meet each other. We'll just do this in 1 minute. Hi, good afternoon, Bethel. Good afternoon. When are you writing your exam? Vokes, you're writing your exam 13th May. Congratulations to you in advance. We look forward to congratulating you at the end of your exam when your result comes out. Bethel is writing in August. Wow, that's still a bit far. Congratulations to you in advance. Oluwatosin May. Victor 8th November. Wow, Victor is preparing way, way, way ahead. Oluwayomife, I don't know if I murdered that, I'm sorry, May. Congratulations to you in advance. We all know why we are here. We are here to learn. We are here to prepare ourselves. We are here to see how much preparation we've done, just to stay at it and be able to say, okay, these things are quite familiar. I'm not scared. I'm not going to this exam scared because these things are quite familiar. And we have a great facilitator to take us through this session to tutor us, to guide us through questions, to guide us through some questions that we've come across during the course of our study or some that we've not come across. And would like for us to listen attentively. If you have any question while the session is going on, please drop them in the chat so that our facilitator can attend to them when he's done. You can, keep dropping when you're writing your exam in the chat box. You can send someone a message in the chat box as well. And yeah, we'll just go into it right now. Our facilitator is currently on the call. His name is Israel Adebomi CFA and is well equipped, very, very well equipped to take us in this section. Sir, you have the floor.
All right, thank you so much, Jessica. Good afternoon, everyone. Hello, just checking if everyone can hear me. I don't know if someone can just signal, so I know I'm not speaking to myself. Hello? Hello?
Israel, we can hear you. The participants are not allowed to speak. They are just to drop their comments in the chat, but we can hear you. Don't worry. Everybody can hear you loud and clear.
Okay, awesome. I just wanted to be sure. Yeah, so my name is Israel Adebomi, and today, for the next 2 hours, I'll be taking the class through equity investment. I understand that the exam is in about 2 weeks, give or take. So I wish everyone the very best. Equity investment is quite a very lengthy topic, or in the CFA level 1 class, covering, I believe the actual curriculum is about 800 pages. So what we're doing here, because this is just a boot camp, a quick revision. So we'll be covering that entire 800 pages of knowledge in like 2 hours. That 800 pages is then segmented to give you a very good understanding of what equity investment is about. So, and it's been broken down into 8 modules. So what I'll be doing for the sake of time, because I want to ensure that we run through every single module. So for the sake of time, I'll be spending the first 20 minutes on module 1, the next 10 minutes on module 2, and in that sequence until we get to module 5 and module 6 as well. And then module 7 and 8 we'll just use 10 minutes. Again, these are the 8 topics. So we'll just dive right into it, right? So the first topic is market organization and structure. So, but before we dive into market organization and structure, just to give you a good background, just so that everyone has a good sense of what equity investment is about. This just complements the other models, right? So equity simply represents ownership in a company, right? So basically, when you purchase equity securities, you become an owner of that business. So that stake that you get when you own a business is what is called equity. And then there are ways to calculate your returns in that equity. It's either through capital gains or profits, which is distributed as dividends that you earn over time. What the key things to know about equity are market structure, right, which determines how you can purchase or sell your instrument, as well as understanding market efficiency, as well as understanding how to analyze companies and valuation methods. So we'll go very in depth over the next 2 hours. So the very first model, market organization and structure. So this particular model covers the function of the financial system, the various assets used by financial analysts, the role of financial intermediaries, the different positions one can take, like either a short or long position, as well as the various types of orders, market participants, primary and secondary markets, and finally the characteristics of a well-functioning financial system. So this starts to give an introduction of a market where you can understanding the market. So equities falls under the market, right? So you need to understand the market before understanding the equity instruments. So one thing you need to know first of all is the function of a financial system, because equity is under the financial system. So there are 6 purposes for which people use the financial system. One is to save money. People use the financial system as well to borrow money. People use the financial system to raise equity capital. They also use the financial system to manage risk, to exchange assets for immediate and future deliveries, as well as to trade on information. The 3 major functions of the financial systems are to achieve purposes for which people use the financial system, to deliver rates of returns, and to ensure that capital is allocated to the best use. Again, I wouldn't go down to dwell on each of these things I've mentioned. So savings, borrowings, raising equity capital, managing risk. I understand that this is a bit simple concept that you can learn on your own, so I wouldn't dwell too much on them. I'm just trying to breeze through. So I'm now going to go to the next segment, which is capital allocation efficiency. Right. This segment then seeks to speak to understanding what the primary capital markets are and being able to differentiate it from the secondary capital markets. So essentially, primary capital markets are the markets in which companies and the government use to raise capital. So economists are considered allocationally efficient when money can be allocated to the most productive use, right? So essentially, projects with the highest NPV or the highest internal rate of return, IRR. So after understanding the difference between primary capital markets and secondary capital markets, right? So essentially, primary capital markets is the first level where companies go to raise money. Secondary capital markets are where those monies are then being traded at. It's then important to understand contracts, assets, and contracts, because in equity investment in particular, these are what are typically used to trade on the market. So trade happens through assets and contracts, right? And then these assets and contracts are classified across different buckets. The first classification is based on the underlying instrument, right? And then there are two categories here. One, they are financial assets and they are real assets. So financial asset essentially means securities like stocks or bonds. Real assets means securities like real estate, equipment, commodities, and other assets. So these are assets that you can hold. So that's the very first classification based on the underlying. The next set of classification is based on the nature of the financial securities. Remember, we just separated financial from real securities. So the next is based on the financial securities. And based on this, there are 2 types of securities. There are debt securities and there are equity securities. Debt securities require fixed periodic payments. However, equity securities, which we'll be focusing on, are the ones that represent ownership or claim on future cash flows of the business. So you own the business and then you have a claim on the future cash flows that are being generated by the business. The next classification is based on where the securities are traded. So it could be publicly traded or privately traded. So for securities that are publicly traded, they are typically being held by exchanges or by dealers. However, privately traded securities, these are not traded in public and are held very privately and are really not subject to major regulations. The other classification of securities and contracts are spot market and are based on the delivery, which can either be delivered at the spot market or at the forward market. So if it's delivered at the spot market, that means that the markets are for immediate delivery of the asset. If it's delivered at the forward market, that means the contracts call for a future delivery of the asset, including forwards, futures, and options. There's also a classification based on the underlying of the derivative contract. And for these, there are financial derivative contracts or physical derivative contracts. I know we've done alternative investment, so derivatives must have been taught. So same thing as I started, there could be financial contracts or fiscal contracts. There are also financial derivatives or fiscal derivatives, which are the derivatives of the either financial contract or the fiscal contract. Also, there is also a classification based on where the securities are being issued. As I said, you can either buy a security at the primary market or at the secondary market. So that's also another way to classify assets and contracts. And the last two base of classification are based on maturity. So if it's going to mature within a year or less, those securities are classified under the money market. If those securities, whether debt or equity, are going to, primarily equities, are going to mature over more than a year's time, it's classified as capital market securities. And then the last one is based on the type of market. Now, there are traditional investment markets, which is what I'm focusing on today. So traditional investment markets are publicly traded debt and equities, whereas alternative investment markets, which was taught yesterday, are hedge funds, private equity, commodities, real estate, precious gems, right? So like gold, diamonds, and the rest. That is alternative investment markets. So those are the two buckets. That are traditional alternative. Traditional are primarily debt and equity, right? But publicly traded debt and equity. The next segment is understanding securities, right? Now, we've largely classified them. So now we need to understand these securities, right? The very first one is understanding fixed income, right? I understand that fixed income was also taught yesterday, so I wouldn't be dwelling on it. But fixed income is the type of security. Again, this first reading is sort of giving a prelude to understand the market before we then go into understanding equities more precisely. So securities, the first one is fixed income. This includes bonds, notes, bank borrowings, and convertible. I know this was taught extensively yesterday. The next, which we'll be dwelling on extensively, is equities. Equities refer to ownership claims by investors and companies. And now there are three primary types of equities. You can become an equity investor in three ways. One, by being a common shareholder. This means you have a residual claim over any asset and income after everybody has been paid. That's the first way, a common shareholder. The second way is by being a preferred shareholder. So these are shareholders that have scheduled dividends and they are preferred, they are ranked higher than the common shareholders. And the last one is warrants. Warrants is the then third category of equity investment, or equity ownership, right, or equity investment. So this gives the holder the right to buy the firm's security at the price, right, called the exercise price. This is very similar to call option, which was taught under the alternative investment. Then the next category is pooled investments. Pooled investments include mutual funds, trusts, exchange traded funds, and hedge funds. They issue securities to represent the ownership in the shared to represent the shared ownership in the assets. Money from several investors is usually pulled together to be managed by a professional money manager according to a specific investment strategy. After this, we then need to understand currencies, commodities, and real assets as types of securities, just to have a good sense before we then go to focus on equities. So the other types of securities are commodities. Commodities include things like precious metals, energy products, industrial metals, agricultural products, and carbon credits, right? You can either buy this and sell this at the spot market, which is buying it and selling it today, or you can buy it in future and sell in future. And then for this, you need to use the forward market or the futures market. For this, we would sorry, I can see that there are some questions. So what I've done is, so I noticed that there are questions around the slide. What I've done is I've largely summarized the presentation into just 8 slides, because I'm trying to ensure that like people can rather focus on just listening as opposed to reading, right? Because I think that's what this session is for, right? You can sort of read on your own, but what I'm trying to focus is this class tries to give you a quick crash course on equity, right? What I can do, if there's enough demand, I can put together a summary note that sort of summarizes the entire equity investment into about 50 pages, right? That you can then go back and then quickly read if there's enough demand for that. But the actual presentation I'm using, because I want to ensure that what is done is more listening, because as I said, it's 800 pages. It's 800 pages of information. There's no way, I'm gonna run through 800 pages in 2 hours. So I'm trying to just focus on the key points to ensure that the understanding is gotten, right? So if there's enough demand, I can then summarize everything I've said into about 50 pages and share with the class. But I'll just plead that you guys just focus more on listening, because there's a lot to cover in 2 hours. So just focus on listening. And then at the end, there's about 10 to 15 minutes where I'll take all the questions. So I won't be able to look at the chat box until the end, until that last 10 to 15 minutes. And then I can take all the questions at that time, because it's a lot to cover. So as I was saying, so commodities, real assets, so I was saying commodities include precious metals, energy products, agricultural products, and carbon credits. They're also real assets. Real assets are, I think, the best you can relate to. So things like real estate. So people who buy and sell real estate, whether it's land or building or a full, or a full estate. These are real assets. Or things like machinery, cars, airplanes. These are real assets. These are synonymous to equities, but these are classified as real assets, right? Equities are financial assets, right? There are also contracts. As I've said, we've differentiated the different types of contracts. But to then draw further down, contracts are the primary ways in which equity is traded at. So you need to understand contracts. And there are 2 types of contracts. There are physical contracts, which largely are used for physical assets, right? So like crude oil, wheat, gold, commodities, cars, airplanes, and the rest. And they are financial contracts. It's important to know that financial contracts are what are used to trade equities and bonds primarily, and fixed income instruments. So it's financial contracts. So which is where we'll be focusing more on. So it's also important to understand the term contract for difference, which is used to allow people to speculate on the price of an underlying asset, right? Now, moving forward, there are 4 main types of contracts that you need to understand. The first is a forward contract. The second is a futures contract. The third is a swap contract. And the fourth is an options contract. So the forward contract is an agreement to trade the underlying asset at a future date at a pre-specified price. It is not standardized and is not traded on the exchanges or in a dealer's market. So this forward contract essentially is it's not a standardized, it's an agreement between a buyer and a seller to exchange assets at a future date, right? So it is not standardized and it is not done on an exchange, right? However, a futures contract is a standardized contract, right? It is a standardized contract done on an exchange, right? And standardization ensures that these contracts can sell faster. So essentially, you can buy faster and you can sell them faster. We'll dwell in detail more about them in subsequent sections. For swap contracts are agreements to swap payments of one asset for another, right? So as opposed to a forward or futures contract where one person is delivering the asset and another person is paying, in a swap contract, two people could be exchanging assets either at the spot market or at the futures market. So swap contracts are contracts where two people decide to swap assets or swap securities, right? And they then need to determine the prices. So examples are interest rate swaps, which you probably touched yesterday under fixed income, or currency swaps. So currency swap means I'm giving you naira, you're giving me dollars. I'm giving you naira, you're giving me pounds, right? So that means two securities are being exchanged as opposed to one person bringing money, another person bringing the asset. And then there are equity swaps. So equity swaps also happen where one person gives you shares in his business, and in return, instead of paying that person cash, you give that person shares in another business. So these are equity swaps. Then there is options contract. Options contracts are call options and mainly put options. This must have been covered under alternative investment as well yesterday. So it's also important to understand within the market structure, it's important to understand financial intermediaries. The three major intermediaries that in terms of if you are trying to sell within the market, within the financial markets, the three major intermediaries are brokers, exchanges, and alternative trading systems. Now, brokers typically help you find counterparties for transactions. And they do not typically indulge in the trade with their clients directly. And there are a very variety number of brokers within the market, right? Particularly in Lagos and Abuja, I mean, there are so many, right? So their job is to help you find counterparties for your transaction where you're unable to find them by yourself. These also include there could be block brokers, investment banks, sometimes also classified as brokers. There are also exchanges. Exchanges are standardized markets that provide places where traders can meet. They regulate traders' actions to ensure smooth and execution of trades. I mean, the most popular for equity market is the stock exchange, right? Which is once your securities become listed, that's a regulated market. There's a fixed price. You can buy and sell at that fixed price. Those are exchanges. And then lastly are alternative trading systems. These serve the same trading function as exchanges, but they have no regulatory oversight. They are where client orders are not reviewed, but are also known as dark pools. So typically, these are very closed. These are like very, very closed structures or systems, typically known as dark pools, where client orders are not really reviewed, but trades can happen within that. So it's typically done to limit regulatory interference within the trades. So that's alternative trading systems. It's also important to understand dealers, who dealers are, and how to differentiate dealers from brokers. So dealers also help clients to either sell or buy, right? But the key difference between a dealer and a broker is a broker would not take a position, right? In terms of helping the client. So the broker would not put his money, right, as part of the trade. Sorry, a broker would not put his money as part of the trade. A dealer, however, typically would take the opposite side of their client's trade. So if you're trying to buy, the dealer would then be on the sell side. If you're trying to sell, as the customer, the dealer would be on the buy side. That's the key difference between a broker and a dealer. The broker just go and help you find the buyer if you're trying to sell, right? It's also important to understand arbitrages. Arbitrages are folks who trade when they can identify opportunities to buy and sell identical or essentially similar instruments. So these folks don't trade every day, or some of them do trade every day, depending on the information, but they are typically trying to speculate and try to take advantage of information gap within the system. So they typically trade across markets, but within the same time points. So I will now also be talking about securitizers, depository institutions, and insurance companies. So securitizers To understand securitizers, you need to understand securitization. So securitizers are folks who enable securitization. Securitization is the process of buying assets, placing them in a pool, and selling these assets that represent that ownership of the pool. One common example is mortgage-backed securities. So essentially, securitizers are folks who they go and buy an entire asset, right? And then they create that asset into units of shares, right? That you can then buy, and then you then own a share in the underlying assets. That's simply what securitizers are, right? I will not be able to go into their benefits due to time. The next categories are depository institutions. This is the most common. So this includes your commercial banks, savings and loan banks, your credit unions, right? These are depository institutions, basically folks who hold money on behalf of customers, right? So they take in deposits, right? And then lastly, insurance companies. So insurance companies are very, very important in the financial market because they help people and companies offset risk by issuing insurance contracts. So typically you pay a premium, and then that premium helps you to offset a risk that may or may not occur. But if that risk should occur, you then get paid a sum to ensure that you are covered for that risk. There are also folks who perform settlement and custodial services. This includes clearing houses as well as depositories or custodians, right? Their primary role in the financial market is to help clients, clearing houses help clients settle their trades. Custodians help clients hold their securities, right? So that you are insulated from loss or from fraud or natural disasters. So because remember I said financial contracts, these are basically instruments, right, to agree. So if you don't want to keep this under your bed, right, there are custodians that help you hold those contracts, right? So it's important to understand who those people are. Also, you need to know that there are positions you can take in equity investments. You can take long position, which is what is most common. Long position meaning I buy MTN shares today, I expect MTN shares to move from 10 naira to 100 naira within 2 months, right? That I'm expecting to gain over, by the share appreciation. A short position is the reverse. I buy MTN share at 100 naira, and I have a view that the shares are going to go down as low as 10 naira, right? That is a short position as an example. So those are the two positions you can typically take. I mean, those are the simplest way. And then there are also levered long and short position, right? By using leverage, which we'll dwell on later as well. But leverage typically means that you are taking debt to increase how much you can buy those shares, right? And then you need to go and learn. I won't be able to do it on this call because of time, but you need to learn how to calculate the return when you take leverage, right? So you need to understand concepts such as margin call, right, and understand the meaning of initial margin and maintenance margin, right? I won't be able to dwell on that because of time, but that's very important concept you need to understand. Right, if there's enough demand, I would add that to the note. I would simplify the formula so that that is well understood. We are going close to the end of module 1, and towards this, we need to understand orders and execution instructions, right? So there are several ways at which you can place orders and execute your your purchase order, and there are different types of orders. There are market orders, there are limit orders, there are stop orders, and then there are hidden orders, right? A market order basically means that you want immediate execution of, so say for instance, you want to buy equity, you want to buy Access Bank shares, and you're like, you place a market order, meaning that market order, you want to buy that shares today, right now, at 12:30 p.m. on Sunday. That's a market order. A limit order, however, is saying you want to buy that share at a specific price. So you give that order to the dealer or the broker and tell them that this is, or you go to the exchange or an alternative trading center and say that you want to buy these shares at this price, right? So you need to wait. So the dealer or the broker has to wait until the shares hit that price before they can place the order. There are also hidden orders. Hidden orders, these are large orders that are not known, that are known only to the brokers or exchanges executing them until the trades are executed. So they are known only to the brokers. So essentially, these are orders. These are typically large orders, and you try to hide these orders so that you don't distort the market price and people don't take advantage of that purchase, and you can make the most of it. So it's only known to the broker, and then once it's then executed, it then becomes public. So it's also important to understand validity of instructions, right? I won't dwell on this. I think it's better you read this on your own. But I'll just speak to stop orders. Stop orders, also called stop loss orders, because it is very important. These are orders that come with a trigger price. So say, for instance, a stop sell order executes only if the price is at or below the stop price or trigger price. So if with a stop sell order, that order will only be executed if the share price, for instance, hits that stop price or below, right? That is a stop sell order. A stop buy order executes if the price is at or above that stop price. That is a stop buy order, right? It's important to understand stop sell, because these are used to stop sell or stop buy. These are used to control your losses, right? As I said before, there are primary markets and there are secondary markets. Then moving into understanding the security markets. So primary markets are where issuers first sell their securities, right? For example, when a private company goes public, its shares are issued to the investors in the primary market before it starts selling in the secondary market, right? And this is what is popularly known as an IPO, right? So an IPO is a primary market instrument, right? But there are other ways to also sell securities, say for instance, via underwriting with an investment bank on the primary market. That doesn't actually necessarily mean it's so an IPO is not the only type of public offering, right? There are also things like private placements. So private placements means that these shares are going to be sold directly to a small group of qualified investors as opposed to going to the public. These are also ways by which equity shares are being issued. There are also shelf registrations as well, and then there are also things called right offerings. Sorry, I'm moving too fast. I'm trying to ensure I can cover as much as possible. It's important to understand, as I said, the difference between primary markets and secondary markets and how to distinguish them. Again, primary markets are where entities go to raise money for the first time, right? Secondary markets are markets where investors trade, buy and sell securities. So investors who already bought at the primary market, if they want to buy and sell what they already bought, they go to the secondary market, right? And then I think lastly, under this is I'll just talk on market regulation. So again, given the complexity of the market, it is very important that the markets are being regulated, right? The primary regulator in our market here in Nigeria is the SEC, right, as well as the CBN for some folks, but primarily the SEC. The role of the market regulator is to ensure fair trading prices, as well as to, one, prevent fraud, control agency problems, promote fairness, set mutually beneficial standards like IFRS and the US GAAP, prevent undercapitalization of firms, prevent undercapitalized firms from exploiting their investors by making excessively risky investments, and to ensure that long-term liabilities are funded. So equity markets are typically regulated, right? And they are primarily being regulated by the SEC, that's the Securities and Exchange Commission for Nigeria. Also, it's lastly important to understand how to identify a well-functioning financial system and how to know if that market is not well-functioning, right? Now, how do you know if a market is well-functioning? One, there are four major characteristics. One, a well-developed markets trade instruments that help solve their financial problems, right? Two is the market will be liquid and it will have low cost. Three is there will be timely and accurate financial disclosures to allow people buy and sell easily, right? And then lastly, the prices would reflect fundamental value. So it will be an informationally efficient market. We'll talk about weak form, semi-strong form, and strong form. I think that is model 4. So this way, we are largely done with module 1. Again, you can just write your questions on the side, or towards the end, I'll go and check the chat box to go through them. So again, that gives a full rundown of module 1, which is just having a full grasp of the market, right? Having a full grasp of the market before then going into equities fully, right? You need to first of all understand the overall market, that equity falls under a bucket, right? That was the major focus on that. I mean, it's more complex, right? Please go back and read it extensively. If there's more demand, as I said, I'll be sending a 50-page summary. The second model speaks to security market indexes, right? And it's important to understand security market indexes because market indexes serve as barometers for market performance, and they provide a benchmark for portfolio evaluation, right? And as you are aware, indexes are one of the most popular ways people buy and sell equity securities, right? Particularly traditional equity securities, that is public equity securities. So what you probably know popularly is S&P 500. You might know the Nike as well. For Nigeria, um, as well, there is the standard index as well for the Nigerian market. So it's important to know how these indexes are being calculated, which is what this model 2 seeks to focus on, right? Now, first of all, you need to understand what an index is, right? An index is an indicator or sign or a measure of something, right? Since an index is a single measure and reflects the performance of the entire security market, it makes it easy for investors to measure and track performance. Security market indexes were first introduced as a simple measure to reflect the performance of the US stock market. So they started off in the US, right? Using the Dow Jones average. Think now the S&P is more popular than the Dow Jones, but the Dow Jones was, how indexes first of all came into light, right? Now, you need to understand how to define the index as well as how to calculate value. You need to be able to calculate the value of the index, and you need to also be able to calculate the returns on the index, right? I won't be able to dwell on the calculations extensively, but I would strongly advise that please take time to ensure that you can answer questions on this, right? Ensure that you can calculate the price returns because it's just formula driven, right? And calculate the total value, right? So you need to calculate price return, total return, as well as the value of the index, right? What I'll be doing is I'll be explaining the types of indexes, right? So the very first one, which is the price weighted index, right? Price weighted index are typically based on the stock prices alone, right? So they are price weighted indexes, they are equal weighted indexes, they are market capitalization weighted indexes, and they are fundamental weighting of indexes. Again, these are typically, just to understand indexes, right? You need to fully understand indexes before you can understand the differences. So typically, the main difference is in terms of how they are constructed and how you can calculate because how they are constructed then determines how you can calculate both the price return, the total returns, and the value of the index. So to understand the construction of the index, right? Constructing and managing an index, right, is similar to building a portfolio of securities, right? The difference is that an index is a paper portfolio. It's not a real portfolio, right? But it consists of real portfolios of actual securities. So, basically, whether it's price weighted, market capital weighted, equal weighted, fundamentally weighted, they are not real, but they consist of real securities under. So this distinction shows to see how that calculation is being done, right? So typically, they are typically constructed based on the target market, the security selection, the weight allocated to each security, and then the index rebalancing rule and the reconstitution rule, right? So for the target market, for an index, you have to first define the target market. Say, for instance, the Dow Jones and the S&P 100 is the security index for the US, right? So within this as well, the indexes also typically define that these are large cap securities, or these are mid cap securities, or these are small cap securities, right? These are also typically defined as well, right? Then it will then show how each of the securities are being weighted. So typically when you buy an index, you are buying a whole list of shares, not just one shares, right? There's also a rebalancing rule that comes with each index and a reconstitution rule. So rebalancing rule means how each security would be rebalanced in terms of if one is, if one is oversold or overbought, right? How to then rebalance the weighting of the index back. Reconstitution means that how the index, you say for instance, the index comprises 50 different shares, right? Reconstitution means how we maybe take out 10 shares and bring in 10 new shares, right? Rebalancing doesn't mean that, you need to understand the difference between rebalancing and reconstitution. Rebalancing means there are 50 shares, there's still going to be 50 shares, but we rebalance in terms of the weighting of from the share number 1 to share number 15. Reconstitution means that we reconstitute, maybe take out 10 and bring out 10, or take out 15 and bring out 15. So each index would define it as a rule. It's typically not arbitrary. It's typically predefined, right? So as I said again, going back to the index weighting, so whether it's price weighting, equal weighting, market cap weighting, or fundamental weighting. For price weighting, the weight of each security is calculated by dividing its price by the sum of all prices, right? So basically, price weighting, that index is 15 indexes, right? Those 15 indexes are being weighted based on their price, right? Based on their price. For equal weighting, the equal weighting method assigns an equal weight to each constituent security at inception. So at the start, all the securities are given the same weight, right? So an equal weighted index can be created typically by allocating an equal amount of money to all securities. So that is how an equal weighted index is built, right? The next is the market capitalization weighted index. In this method, the weight of each security is determined by dividing its market capitalization with the total market capitalization, right? So as opposed to price, where you're just using the price, the share price of security. In a market cap weighted index, you are going to calculate the market cap, which is the price times the total shares outstanding to determine the market cap of the security, and then use that to then weight it across the index. For fundamental weighting addresses the disadvantages of using market capitalization weights. Instead of using a stock's price as a measure, fundamental weighting uses measures such as book value, cash flow, revenue, earnings, and dividends to calculate the weight of each security. So if that index is not measured by price, it's not being weighted by price, it's not being weighted by an equal weighting where every stock has identical weights, or it's not being weighted based on market cap, then what's going to be happening, what's likely happening is that index is adopting a fundamental weighting, which could be based on the earnings, sales, book value, or dividends, right? That means that is what is then used to weight the index, right? And then that means that would have been pre-stipulated and predefined, right, as part of the rules of that index. As I said, is very, very critical that you understand the meaning of rebalancing and reconstitution, right, within index management, rebalancing and reconstitution. I already explained it before, but I'll just repeat it. So rebalancing means that you are adjusting the weights of constituent securities in an index to maintain the weight of each security in the index. So you are not adding any security, you are only adjusting their weights within the index. You are not removing or adding. Reconstitution, on the other hand, is the process of changing the constituent securities in an index, as opposed to rebalancing, where you are not adding or removing, you're only adjusting their weights, right? Reconciliation means you are likely adding and removing securities from the index, right? That is the primary difference. Then it's important to understand the uses of market index. Market index serve the following purposes. One, index performance serve as a proxy of market sentiment, so they help you with the market. Two, invest management performance can be better evaluated in comparison with suitable index that serve as a benchmark. Three, they serve as a proxy for measuring and modeling returns, systematic risk, and risk-adjusted performance. Four, they serve as a proxy for asset class performance in asset allocation models. Five, they are very useful in creation of passive portfolios that track index funds and equity traded funds, and exchange traded funds. So equity indexes can also be classified into broad market indexes, multi-market indexes, sector indexes, or style indexes. For broad market indexes, these provide a proxy for the overall performance. For multi-market index, these are typically constructed from several indexes of different countries, right? So countries can, so it could include a multi-market index, where that index is constructed based on securities, say for instance, in the US plus the UK plus Canada, etc. That's a multi-market index. A sector index is constructed to track the performance of a target sector, be it finance, technology, consumer, or what have you, right? That's a sector index. So where you have an index that only comprises of securities within a certain sector, that's a sector index. Say for instance, if you have an index that only constitutes all banking securities, so Access Bank, the Fugas, First Bank, Union Bank, etc., right? That would be a sector index. There are style index. Style indexes are defined based on the characteristics of the securities. It could be based on market capitalization. So say for instance, you have a large cap index or a small cap index. It could be based on their style, either their value or growth. Say for instance, it could be a value index, take mature businesses like Dangote, like MTN, right? An index that comprises those very, very mature and legacy businesses would form like a style index as well, based on value. Then it could also be a combination of market cap and value or growth, right? That is an example of a style index. So again, there are four types: the broad market, multi-market, sector index, and style index, right? Then it's also important to understand fixed income indexes, right? As opposed, this can also be compared to equity indexes, but fixed income indexes are difficult to construct and replicate, right? Types of fixed income indexes, right, as well, are typically being dimensioned across market type, maturity, and credit quality, right? So as opposed to where equity indexes are dimensioned based on broad market, multi-market, sector, and style, for fixed income is dimensioned based on the market as well, based on type. So whether it's a corporate fixed income instrument, whether it's a government agency instrument like the FGN bonds, etc., or whether it's a collateralized or mortgage back, then they are also being classified based on maturity, right? So whether it's a short term, medium term, or long term, right? Or based on the credit quality. So some could be high yield, some could be investment grade, right? Then lastly, there are indexes for alternative investment. So same way there are indexes for equities, fixed income, there are indexes for alternative investment. There are commodity indexes, right? So indexes that are made to track products such as precious metals like gold, diamonds, or indexes. I think this one is very popular, to track things like crude oil price, right? Or to track very popular commodities that are popularly traded like wheat and sugar as well. But what's even more popular are real estate investment trust indexes. So REITs, right? So there are indexes, there are REITs indexes as well. There are also hedge fund indexes. So hedge fund indexes reflect the returns on hedge funds, right? So again, just to summarize, there are indexes across equities, across fixed income, and across alternative investments. For alternative investments, it could be commodity, real estate investment trust indexes, which are REIT indexes, or hedge fund indexes. So that brings us to the end of model 2, right? Moving to model 3, which is market efficiency and behavioral finance, right? Market efficiency concerns the extent to which market prices incorporate available information. So investors are interested in market efficiency because if prices do not fully incorporate information, then opportunities exist to make abnormal profits. So market efficiency helps us to understand how markets function, right? So that you can analyze whether the market is weak, the market is or whether the market is very strong, right? Or whether the market is somewhere in between, right? And then to understand that, once you understand that market, right, you need to know, okay, is this market weak, strong, or somewhere in between? It's very important to be able to make that. It's very important to be able to identify that, because once you identify that, that then determines how you can trade. For instance, the US market is seen as a very strong and efficient market, right? And then we understand the characteristics. Most emerging markets or frontier markets are seen as weak form. Some may be strong form, but most are seen as weak form, right? Which means that traders have different behaviors in a weak form market and in a strong form market. Say, for instance, if you are trading in the US, buying and selling equities in the US, you cannot exhibit the same characteristics when you are buying and selling in markets like Nigeria, for instance, or other emerging markets, right? So it's important to understand how to distinguish both markets. So before we get there, you need to understand market value versus intrinsic value. Now, what are market value? Market value of an asset, it is the current price at which that asset can be bought or sold. Now, this doesn't necessarily mean that that's the real value of the asset, but that is the value at which, if you go to the market and you want to sell that instrument, that is the value at which you would buy that instrument. Or if you are the one that owns the instrument, that is the value at which people would sell that instrument. Now, that doesn't mean that is the actual worth of that instrument or that security or that asset that you have. That simply means that is the market value. So if you have a pen and you want to sell that pen today, what is the market value doesn't mean the intrinsic value. It means this is how much people are willing to buy or sell it. The intrinsic value, on the other hand, is the actual value of the asset, right? Not being determined by how much people are willing to pay for it. This means that this is the actual amount that that asset is worth, right? Say, for instance, your iPhone 15, right? Your iPhone 15 could have an intrinsic value, but that intrinsic value doesn't necessarily mean that's the market value based on where you are, whether you are in Lagos or you are in Sokoto or Borno. The intrinsic value and market value in Lagos State and in Borno or in Zamfara State will be the same. But the market value in Lagos State and in Borno State, for instance, will be very different. So it's important to understand how to calculate and measure both. I'm just using that as an example, but for equities, it's very important to be able to calculate the market value of a share and the intrinsic value of a share in equities. Now, this is a very important concept to know when you are trying to distinguish weak form, semi-strong form, and strong form, right? For the weak, in a very strong form market, right, in a very efficient market, the market value would be equal to the intrinsic value, which means that that market is reflecting all the information available, right, in the market. And that must mean that there are a lot of buyers and sellers to ensure that that market is informationally efficient. So the key characteristic of an informationally efficient market is that the market value of your asset would be equal to the intrinsic value, which means that if I believe this is how much my asset is worth, if I go to the market, that is the same value I would get for that asset. In an informationally efficient market, if you estimate that your asset is worth 100,000 naira, right? When you go to the market, someone tell you I want to pay you 5,000 naira. That means that market is not efficient. Now, there are factors that affect market efficiency, including trading costs, right? Other factors include market participants. So the number of people participating in the market also affects the efficiency of the market. The information availability and how they disclose financial information affect the efficiency of the market. The limitations on arbitrage and short selling also affects the market. Can people short sell? That also affects how efficient the markets are. Things you need to understand as part of efficient market are transaction costs and information acquisition cost. So if there is a high transaction cost, likely that market is not efficient, right? If you need to spend a lot of money just to buy or sell as part of the cost of buying, right? That means that market is not efficient, right? And then the reverse as well. If you spend less, that means the market is more efficient. Same thing with information acquisition cost. If you are trying to determine, say, for instance, the price of MTN shares, and you have to spend a lot of money to go and calculate it, that means that market is not efficient. But if you can do it from your desktop and you can do this for so many shares, that is a sign of an efficient market. Now, to go directly now into weak form, semi-strong form, and strong form markets. For weak form markets, would reflect past market data. They, however, would not reflect public information and would not reflect private information. Semi-strong form markets would also reflect past market data. They would reflect public information, but will not reflect private information. The strongest form of the market will reflect all types of information. They would reflect both past market information, public information, and private information. So it's important to note this categorization. So first of all form of the market, whether it's weak, semi-strong form, or strong form, must reflect past market data, meaning that any market that doesn't reflect past market data is dysfunctional. And I mean, we don't even recognize that market. So first of all markets must reflect past market data, must reflect the track record, whether it is weak form, semi-strong form, or strong form. All the three must reflect past market data. If past market data is not being reflected, that means that market is dysfunctional, right? Now, if the market reflects both past market data and public information, that means that market is semi-strong. If the market reflects public information, private information, that is the hardest for any market to reflect because people hide their private data. But if that market reflects even private information, right? Public information and past market data, that means that market is very, very, very strong. Right now, that is the way to differentiate the three markets, right? Now, what are the implications, right? The implication means for a weak market, what are the implications? In a weak market, investors can earn abnormal returns by trading on the basis of past trends in price, which means that in a weak form market, you are able to make significant alpha, right? You can make significant returns in that market because there is a dichotomy of price. There's a significant information gap, right? So what happens in weak form market is one person can know so much and the other person knows very little, which creates a room to make significant abnormal returns, right? Meaning that a lot of technical analysts assist in maintaining weak form efficiency, if you understand. So a lot of market participants, that's why regulators are important, prefer a situation where the market is a bit weak so that they can make abnormal returns. That is the implication. In a semi-strong form market, analysts must consider whether the information is already reflected in security prices and how any new information affects a security's value, because past trends are already there, public information is already there. So what happens in semi-strong form markets is fundamental analysts assist markets in maintaining semi-strong form efficiency. right? So where in weak form is more technical analysts assisting to maintaining weak form so that they can rely on past data, past trend to make decisions. In semi-strong form, fundamental analysts, so folks who focus on information, right? That's trying to make money using private information, but I mean public information, right, available as well as past trends, right? There are folks that so fundamental analysts focus more on maintaining semi-strong form efficiency. Securities markets are not strong form efficient. So this is a key concept to know. Security markets are not strong form efficient markets, right? Because it's very difficult um for folks to have for the markets to reflect within a security market private information. So investors trading on private information can make abnormal profit in a strong form market. So it's important to understand market pricing anomalies across time series and cross-sectional, that's across markets. So time series anomalies, they are calendar anomalies. So the returns in January can be higher than the return in any other month. This is a time series anomaly. This is a calendar anomalies. This is a calendar anomaly, rather. There are momentum and overreaction anomalies. So momentum effect reflects to the findings that stocks that have experienced high returns in the short term tend to continue to generate higher return over subsequent periods, right? Now, there are cross-sectional anomalies, right? Cross-sectional anomalies could be value effect or size effect, right? A size effect anomaly means a small cap stock tends to typically perform better than large cap stock. This is an anomaly that but exists in a lot of markets. There's also a value effect anomaly, which means that value stock tends to perform better than growth stock, right? Other types of anomalies are closed-end investment fund discount. So closed-end investment funds sell at a discount to NAV. This is seen as an anomaly. Earning surprise as well. Investors can earn abnormal profit by buying stock of companies with positive earning surprise and selling those with negative earning surprise. This is also seen as a market anomaly. So if you have information that a company is going to announce a positive earning surprise, if you have that information before the company makes the announcement and you buy the company's stock price before the announcement is done, there's a high chance that you're going to make a significant abnormal profit. But that's an anomaly in the market, which means that the market is not very efficient, right? If not, it should have already reflected that information. IPOs also, this is another anomaly. What has been found in the market is that prices rise on the listing day, but then they tend to underperform over the long term. So if a company is going to IPO tomorrow, which is Monday, what you'll find is that if the company is trading at 12 naira today, by tomorrow, the company's share price is likely to rise to 12 naira, which means you can also make, or more than that, which means you can also make an abnormal profit. But that's an anomaly because what happens over time is that the share price then goes back to rebalance, which means the market is not efficient, but that's an anomaly that has been observed. So it's important to understand this. The last section of this of the reading covers behavioral finance, right? Understanding how human psychology, or rather, trying to use human psychology to understand how people make investment decisions, right? Because what you'll find is the behavior of some investors are quite irrational, right? So behavioral finance uses human psychology to explain those investment decisions. So some of the irrational behaviors and biases that have been observed are broken down into 8. The first one is loss aversion. It's been observed that investors dislike losses more than they like gains of the same amount. So this is loss aversion. So people typically hate losses more than they like gains, right? So this is a behavior that has been observed and is an abnormality, which means that if you give someone the option of, will I feel more pain if I lost 5 naira versus will I feel more joy if I gained 5 naira, right? That person would feel way more pain by losing 5 naira compared to the joy the person feels by gaining 5 naira. Heading behavior is another behavior that has been observed in the market, which is another behavioral bias, right? In heading, investors ignore their private information and typically act as others do. So this is a typical investor characteristic. Another one is overconfidence. Overconfident investors typically do not process information. They place too much confidence in their ability to process and analyze information and value security. So a lot of them make decisions based on their ability as opposed to carrying out rigorous analysis and relying on the analytical outcome of the research to make a decision. It's a common behavior. Also, there's information cascades. Information cascade is when people observe the action of a handful of market participants and blindly follow their decisions. So very similar to heading. Other types of behavioral biases are representativeness, mental accounting, conservatism, and narrow framing. Representativeness means that investors with this bias will assess probabilities based on events seen before or prior experiences instead of calculating the new outcomes, which means that most investors typically just rely on, or some investors, but it's been observed that among of many investors, that they rely on things that have happened in the past to make a decision as opposed to calculating the likely occurrence of future events. Mental accounting as well. What people tend to do is people tend to create a mental account in their head as opposed to seeing them as a total portfolio. In case in point is you might see an individual who has maybe 3 or 4 bank accounts, right? And that person mentally is maintaining separate, bank balances, right? And that person sees account balances in those 4 different, as opposed to looking at it from an holistic view that this is my total bank balance, right? It's just being held in different pockets, right? So it's a common behavior, particularly among equity investment holders, right? So folks who buy shares in, let's say, GT Bank, buy shares in this. So they typically hold it separately as opposed to calculating the total portfolio, calculating the total return. Also, conservatism. Conservatism. Investors tend to be very, very slow to react to changes. Then lastly, narrow framing. Investors focus on issues in isolation as well. So these are the typical behavioral biases that have been observed in the market. Now, behavioral biases affect all investors irrespective of their experience. And understanding of behavioral finance will help individuals make better decisions, both individually and collectively. So it is very important that you analyze whatever behavioral bias, especially if you're on the advisory side, your client or customer may be exhibiting, right, as part of providing advice. So this brings us to the end of module 3, and now we are halfway through and now going into module 4. And module 4 is to then go, we then begin to go very in depth. So between module 4 and module 8, that's the next 5 modules, we'll then go into in-depth knowledge of equity investment itself. So I'm just trying to check. I think there's a break, so I'm trying to check when the break is supposed to come out. Can someone help me? Okay, there's no break, so it's 12 to 2. Okay. So I thought there was a break in between. All right. So we'll then be moving into overview of equity securities, right? So as I said, now from module 4 down to module 8, we'll now be focusing in depth on equity securities. Again, I'll be a bit faster than even the last 1 hour, because now I want to cover the next 5 modules in less than 45 minutes. So it's important it is important to understand equity securities, which is what this module in particular will be focusing on, right? So equity securities, right? In the global financial markets, right? I'll just jump to the characteristics, right? And we already mentioned it before, but there are 3 common types of equity securities, right? Three major types. So it's either common shares, preference shares, or warrants, right? But there are other types, but those are the three major ones. But then we'll then go in depth. For common shares, as I said, represent ownership interest in a company and give investors a claim on its operating performance, right? The opportunity to participate in decision making, as well as a claim on the net assets in the case of liquidation, right? So this is the most common type of shares, right? This is the most common type of ways people participate in equity investments by owning common shares, as opposed to preference shares. What you find within common shares there are also categories of common shares. There could be class A or class B or even further classes of common shares. And then these roles are typically defined in the Articles of Association or the Memorandum of Association of the equity instrument, right? And then these classes will then stipulate who has more rights when it comes to voting, who has preferences in terms of the distribution of dividends, etc. Preference shares, these aren't so common in practice, but these are also very, very, very common ways in which people also participate in equity investment, right? Preference shares are a form of equity in which payments are made to a preference shareholders take precedence over common payments to common shareholders. So meaning that if you are a preference share investor, right, you will be paid first before the guy who owns the common shares, right? There are different types of preference shares. There are cumulative preference shares, there are non-cumulative preference shares. Cumulative means that a dividend are not paid out for a year or two. They are typically cumulated, and then by year 3, dividends are being paid. You'll be paid for year 1 and 2. Non-cumulative means that if dividends are not paid out for year 1 and 2, the firm decides to pay dividends in the third year, it would only have to pay third year dividends, right? There are also participating and non-participating preference shares. For participating preference shares, as the name implies, preferred shareholders participate in the firm's profits. So shareholders receive extra dividends than the pre-specified rate in cases of higher profits, right? Non-participating shareholders receive only the pre-specified rate, even if the firm earns higher profits. The shareholders only receive the par value in case of liquidation. And lastly, there's convertible preference shares. So convertible preference shares are those that can be converted to common stock, right? And hence have a lower risk, right? Now, it's important to understand private versus public equity securities. Very, very important. Remember, public equity securities are falls under the traditional investment asset class, but private equities fall under alternative investment, under the alternative investment class, which I think you must have covered, right? So we've largely covered private equity, but I mean, we'll still talk about it. So, but private equity refers to the sale of equity capital to institutional investors via private placement. The key characteristics of private equity are: one, less liquidity as opposed to publicly traded shares, because this happens in private markets. Two is price discovery can be biased as the security is not available for valuation by a broad base of public participants. Three, management can focus on long-term value creation as it doesn't have to worry about reporting results to the market. Four, lower reported costs due to lesser regulatory requirements. Five, potentially weaker corporate governance due to lesser regulatory requirements. And lastly, there's a potential for generating high returns when investment is exited, right? What you find is there are types of private equity as well. There is venture capital, there are also leverage buyouts, and then there are types, that's private investment and public equity. For venture capital typically refers to capital provided to firms at the early stage. So what you'll find is seed capital, startup capital, early stage and mezzanine financing. This falls under venture capital. And these investments are typically illiquid and require commitment of funds for typically 3 to 10 years before you can realize your return or get your money back. For leverage buyouts, these are large amounts of debt relative to equity the company used to buy out a firm. So a leverage buyout happens when an investor goes to the market to raise a significant amount of debt to buy equities. So if you go to raise debt to buy equity or a mix of debt, right, to buy out equity or to buy out a firm, which is buying out equity, that's a leverage buyout, right? When this is performed by management, it's a STEM management buyout. So if it's the management, that's if it's the directors of the business going to buy out the shareholders of the business by raising debt, then that is called a management buyout. Now, there are non-domestic equity securities. A market is said to be integrated with the global market if its capital flows freely across its borders. The key reason why capital flows into countries' equity securities might be the key reasons why capital flows into equities might be restricted includes one, to prevent foreign entities from taking control over domestic companies, to reduce the volatility of the financial market, and three, to provide domestic investors with an advantage, right? Now, there are two major ways to invest in equities in a foreign market. So if you want to buy shares, for instance, in Ghana or, a neighboring country like Togo, Cote d'Ivoire, or South Africa, right, or in the US, the ways you can do it overseas is either through direct investing or through buying depository receipts, right? So direct investing means that you go and actually acquire the shares directly, right? Typically, you will need a dealer, a broker, or you will need an investment bank to execute that. Or you can also purchase the shares through a depository receipt, right? I will then jump to the characteristics of equity securities, right? There are two main sources of returns for equities. It's either you make your money through capital gains, that is appreciation of the price, or through dividend income, that's distribution of returns on those securities. Those are the two main ways you can make money when you invest in equity. So either the company appreciates, that's capital gains, or dividends are distributed. Now, what are the risks of equity securities? Now, there are several risks associated with investing in equities, right? This includes this includes say for instance for preference shares, right? Dividends on preference shares are fixed as a percentage of the par value, right? Dividends are paid before common shares. On liquidation, preference shareholders get par value of the shares, right? But typically what you find is preference shares are less risky because of this characteristic that I just mentioned, as opposed to common shares. So common shares are more risky than preference shares. They are also cumulative, as I said, cumulative versus non-cumulative preference shares. Again, cumulative preference shares are also less risky as opposed to non-cumulative, right? Because these are questions that might also come up as well. So companies typically issue equity in primary markets to raise capital and increase liquidity. I think I mentioned this before. Typically, they go to the primary market first, and then folks who purchase in the primary market can then resell in the secondary market to trade their returns. Now, some of the key accounting ratios used to determine your profit are the ROE, that's return on equity. So it's important to understand the calculation of this. It's also important to understand cost of equity and to understand how to distinguish between cost of equity and return of equity. So this largely serves as the introduction into equity securities. That's module 4. For module 5, we'll then be going into being able to perform a company analysis, right? So it's important that you understand how to perform company analysis so that you know when to buy or sell a share, right? You know how and when to buy or sell an equity investment, right? So this particular module is very much illustration driven, but for sake of time, we'll not be able to dwell on it. So I advise that again, you focus on solving more examples for this model, because I want to ensure that we reach the last model, right? So I'll just be focusing on the key points during on the model. So the first part of the company analysis is you need to be able to determine the business model. That's your very first step, right? You need to understand the company's business model. How does this company make money, right? To do this, you need to understand, one, what product or service is this company selling? Two, you need to understand who are the key customers of this company. The third thing you need to understand as part of determining the company's business model is the sales channel, including customer acquisition and product/service delivery mechanisms. The fourth thing you need to understand is how the product or service are priced and paid for. Essentially, how much does the company charge and how are prices and payment structure determined? The last thing you need to understand when you're trying to analyze the company is the resource supplier partner relationships as well. So meaning that who does this company buy from and rely on? Who are their key suppliers? Who are their major operating partners? Right? These are the key questions you need to understand to know these are the key questions you need to ask to understand the business model, which is the first step of performing a company analysis, understanding the business model. Now, to get information on this, you can either use the issuer sources such as regulatory filings for public companies, any press information they've released, or check their website. You can use third-party sources, right? Use industry information, use social media as well. You can use proprietary third-party sources, right? Either you're using analyst reports like Wall Street analysts, credit rating companies, or platforms like Bloomberg and FactSet. Also, you can perform proprietary primary research, right, by actually going to, distribute surveys or speak directly to management. These are ways at which you can answer those questions to understand the business model of the company, which is the very first step in performing a company analysis, right? Now, after you've performed the company analysis, the next thing you must do is perform a revenue analysis, right? A revenue analysis, what you have to do next is you need to understand. So after understanding the company's business model, you need to understand the historical financial statements of the company, right? So basically understand the key drivers of revenues, understand the key drivers of profits, understand the key drivers of cash flow, and understand the company's financial position, right? So because these key drivers, as I mentioned, revenues, profit, cash flows, and their cash balance, right? Their financial position, cash and asset balance is what will help you understand how they make money, right? And how they drive their revenues and how you can use to predict their revenues in the future, right? So revenue analysis can be done by either using a bottoms up or a top down approach. A bottoms up approach breaks down revenues into drivers such as sales volumes and prices, byproduct line or segment, right? A top-down approach, however, expresses revenue as a function such as market share, market size, and GDP growth. So, meaning that they are trying to project the company's revenue. If you are using a bottoms-up approach, what you're trying to do is you're trying to break down their total sales, right? You identify all their products and the price of each product, and then try to project how much they would sell and how the prices would grow over a certain period of years. If you're using a top-down approach, which is more textbook as opposed to practical, what you're doing is you're determining the market share, right? Okay, say for instance, this is the total market. Say for instance, if it's a farming business, right? This is the population of Nigeria, right? Then these are the people I can sell to. This is the size of the market. Then these are the people you now break down that 200 million into the amount you can service out of the 200 million and then estimate your revenue based on that population, right? That is a more textbook approach. Think What is more practical is to do a bottoms-up approach, but both approaches are what can be done to analyze the revenue of the business. Also, as I said, pricing power is very important. You need to understand the company's ability to set prices. Is the company a price maker or a price taker? Right? Does the company have the ability to set its own price independently? Or does he have less ability to do that and has to just take the market price, right? And that would typically determine on whichever spectrum the company is playing at. So that's another analysis that has to be done as part of the revenue analysis, which is after you've done. Again, I said the first thing is to do, the first step of performing a company analysis is to understand the business model. The next step is to understand the revenue model. And as part of the revenue model, you need to understand the pricing power. After that, you then need to understand the operating profitability and perform an operating profitability and working capital analysis, right? So to do this, you need to understand what are the operating costs. Now, you understand the business model, you understand the revenue of the business. The next thing you need to understand as part of analyzing the company is what are the operating costs of the business. I know the revenues. Now I need to know the cost of this business. What are the costs that this company incurs every day, right? That is the next layer. So then you need to understand also as part of the operating cost, other costs that you need to also understand as part of understanding the total profitability and working capital are things like the investing cost as well and financing cost. So, because most companies would have debt and equity, so meaning that they must pay out both debt and equity to their investors. And for investing costs, they have to make distributions to their shareholders, and also they must invest in replenishing their assets. So the assets that they are basically using to generate income, like property, their equipment, their patents, they need to reinvest in these assets. So it is important to analyze this cost as well and pair them with revenue to be able to determine the total profitability of that asset. Right. Again, there's a simple formula for calculating profit. This formula is simple. I will leave it to you to go and understand, but it's right here. So it's just basically revenue minus cost, but it's then broken down into gross profit, which is calculated as price minus variable cost times quantity minus fixed cost. Right. So understand how to calculate the profitability and analyze the profitability of the business. Now I understand that you guys have done FSA, as financial statement analysis. Right, because you need to understand how to break down the financial statement of the business to determine gross profit, to determine EBITDA, as well as to determine the operating profit, right? You need to understand how to break that down, right? So that you can compare that across the business. So that is what you need to do to perform a company analysis. As I said, number one, understand the business model. Two, understand the revenue. Three, understand the profitability and working capital cycle, right, of the business. Then the last part is understanding the capital investment and capital structure of the business, which means that the sources and uses of capital. So an important part of company analysis is to determine whether a company creates economic value for its investors, whether the required rates of return of debt and equity investors have been met or exceeded. To evaluate this, an analyst must first need to understand the company's sources and uses of capital, meaning that you must understand how the company gets its money. Does the company get its money from the bank? Does it get its money from the equity market? That is the general equity market. Does it get its money from private investors like DFIs? Or does it get its money from grants from government institutions? You need to understand that, where the company gets its money from. And then you need to understand, okay, where does this company apply most of the money to? And does the money go more towards servicing operating costs, such as paying staff salaries, paying for administrative and utility costs like electricity costs, other operational costs and maintenance costs, or the most of that money go into investment, right? So expansion of the business, things like buying more fixed assets for the business, plant machinery, scaling the business, right? You need to understand how to dimension that, right? So that is the last part. Again, I'll just do a quick recap because that brings us to the end of module 5 as we go into module 6. So essentially, to perform a company analysis, you need to start by performing a business model analysis. After that, you need to perform a revenue analysis. You then need to perform a profitability analysis and working capital cycle analysis, and then understand the capital investment and capital structure. Right. As part of the capital structure, what you need to do is be able to compute your work, right? Understand the work of the business, right? And then think you should be able to do this formula by now, right? Or you need to learn it. I won't be able to cover it today. So for module 6 then go to industry and competitive analysis. So after you've understood the company, you need to understand the industry the company plays in, because no company operates in a silo. They operate within they exist within a very large market. So you need to understand where they are operating in and who their competition, and you need to understand who the competition is. Now we'll go into another step-by-step analysis of how to perform this industry and competitive assessment, right? The very first step you need to perform is to define the industry, right? To do this, you can use third-party industry classification schemes. You can use your judgment as well to define the industry, right? After that, you need to perform a survey, right, to know the size of the industry. You need to know the size of the industry. You need to know the growth rates of the industry, the character, the profitability, and the market share trend of the industry. After defining the industry, after performing an industry survey to have a good understanding of the industry, the next step is to perform an industry structure analysis, right? And this is where the Porter's 5 forces comes in, right? This is the most important factor, and this is what you need to monitor, right? So first of all, you've done your industry survey, you've defined the industry, so you can say, okay, this company operates within the consumer industry, right? This company falls within the top 10 players in the industry. Now, that's what you have done already. Then after doing that, you then now need to understand the structure of the industry by using the Porter's 5 force analysis to understand the structure of the industry that you defined and that you surveyed. And then to do this, you need to know who are the rivals, who are the rivals in the industry, who are the key rivals in the industry. You need to understand the supplier power, right? That supplier's ability to pressure input costs up or to pressure input cost up or otherwise. You need to understand the threats of new entrants. You need to understand substitutes. You need to also understand the buyer power, right? So the Porter's 5 forces, you need to use that to understand the industry. That is the third step to understand the industry structure. The fourth step is then to understand the external influences using your pestle analysis. So using that pestle meaning political, economic, social, technological, legal, and environmental influence on the industry. So you need to use your pestle analysis to understand the external influences in the industry. And then lastly, you then perform a competitive analysis. So I will just quickly go through speaking through a further breakdown, right? Just so that this analysis can be done, right, quickly, just so that you have a better understanding. So for the industry classification, an industry is commonly defined as companies that sell similar products from the perspective of the customer, right? Now there are different types of classification. There are third-party industry classification schemes, right? The three widely used classification industry schemes are the GEECs, right, classification, which is the global industry classification standards, such as the MSI and the S&P and the Dow Jones indices. That is one classification scheme. There's also the ICB by FTSE Russell, which is the industry classification benchmark. And then there's the TRBC, which is the Revenue Business Classification. So the GICS, that's Global Industry Classification Standard, the ICB, Industry Classification Benchmark, and the TRBC, that's the Revenue Business Classification. These are the three commercially used industry classification schemes. Right, and then it's then broken down. This is within your material. For the geeks classified industries into 11. ICB classified industries into 11 as well. CRBC classifies industries into 14 categories. So it's important to understand just the distinction, right? I won't be able to do it on this call, but it's important to go back and then just quickly refresh your head around that. So there are limitations around industry classification schemes. The four major limitations are: one, groupings of companies with business model variations or that sell substitute products. Two is the classification of multi-product companies. Three is geographical considerations. And four is changes in groupings over time that affect prior period comparability of industry statistics. So these are the factors that affect how these industry classification schemes actually function in practice. So for industry survey, so that part is very important in terms of defining your industry, right? As I said, that's the first step, right? I'll just recap the 5 steps so that we can, there's a perfect understanding. The 5 steps are: one is we need to define the industry, right? After defining the industry, we need to perform an industry survey. After performing an industry survey, we then need to use the Porter's 5 forces to determine the structure of the industry. Then number 4 is to determine the external influences using the pestle analysis, right? And then number 5 is to perform a competitive analysis. So we've just talked about defining the industry, where you can use the GICS, the ICB, or the TRBC, right, to define the industry, right? Does this company fall into energy, financials, information, blah, blah? These are already defined by those 3 common benchmarks. Now, in terms of the industry survey, right, which is done after you define the industry, right? You can do this by, you need to estimate the size and calculate the historical growth rate and the nature of the growth rate, right? As well as measure the profitability and identify any major industry players and market share trends over time in the industry. So you need to start by the industry size and historical growth rates, right? After this, you need to start by characterizing the industry growth rate as well, right? So you need to know, okay, at this mature within the industries, and does this company fall into the mature segment, the growth segment, the cyclical segment, or the defensive segment, even within that industry? Also, you need to perform measures of industry profitability. So things like understanding the profitability of the industry. So the return on invested capital for the industry, right? That's the ROIC for the industry. Also, you need to understand the market share trends and the major players in the industry. So there is a very popular HHI. Please try and learn this. The HHI, that's the Effindale Hitchmans Index. I remember this came out during my exam. So this is frequently used to measure industry concentration. So you need to also perform this to understand how the industry index is calculated, right? And to understand the concentration, right? This particularly measures the concentration of the industry. So now the next step after you've performed after number 1, define the industry using the GICS, ICB, or the TRBC. Then you need to do an industry survey. After you've done the industry survey, the next step is to understand the industry structure, right, using the Porter's five forces, right? So basically, what are the threats of substitute products? That's the first step, right? So you need to understand, can people substitute the products of this company? And what is the threat of that substitute? Say, for instance, the threat to Samsung is iPhone, right? The threat to Samsung is the iPhone operating system. So if you're analyzing the iPhone, you need to go and understand. If you're analyzing the iPhone, you need to go and understand how much of a threat Samsung is, right? The next step is the bargaining power of your customers. So do your customers have an ability to reduce your prices, right? How much power do they have? So how much power do you have over them, right? You need to understand that. Next thing you need to understand is the bargaining power of your suppliers. How much power do your suppliers have to increase the prices, or at which you purchase from them, right? You need to understand how much power they have, which is determined based on the forces of demand and supply, right? You also need to understand the threat of new entrants. Is this business a business where someone can wake up tomorrow morning and start competing with me at the same level, right? You need to understand the threat of new entrants. Then lastly, you need to understand how intense your rivals are, right? What's the intensity of the competition, right? How intense. So those are the Porter's five forces to understand the industry structure, right? The next thing is you need to understand the external influences. So economic influences, right? So things like interest rates, GDP rates, inflation. You need to understand that social factors. How do people spend their money in this market, right? What do they like? What are their savings behavior? What are their investment behavior, right? What are their preferences? That's the social factor you need to understand. You need to understand technology influences as well. Could technology affect you or help you in that line of business or take you out of business? Legal influences as well. You need to understand how frequently laws and regulations change. Say, for instance, you are in the driving or automobile sector, you need to know that laws change very frequently, for instance, in that sector, and you need to stay very, very glued to how those policy changes can affect you. Also, environmental factors, you need to understand. Say, for instance, a farmer needs to understand the climate very well, the raining season, the dry season, when the weather becomes very harsh, for instance, right? Those are factors that is also the next step. That's the fourth step. So we define the industry, we've done the industry survey, perform the industry structure, use Pesto to do the external influence. Then lastly, we need to do a competitive analysis. So competitive analysis. So for this, you need to know, does this strategy create a defense against the five industry forces? That's a question you need to ask. Does the strategy benefit from, or is it at least, at odds with the expected external industry influences, right? And does the company have the resources to execute the strategy, right? So you need to understand the competition of the industry, right? And understand how well the company is positioned based on its current strategy to tackle the competition. So again, those are the five steps to perform an industry analysis. Number seven, so we're almost done. Number seven is forecasting, right? Forecasting is sort of the next step of company analysis. And the last module is on equity valuation, which I would also touch. So for forecasting around that company analysis, after you've done you understand equities, then you've done your company analysis, you've done your industry analysis. At this point, you can now forecast, right? You can now project the performance of the business over time. So things that which you can forecast are things such as the revenues of the business, the profit of the business, the cash flows of the business over a set of period, right? Now, there are principles for forecasting, which we'll quickly run through. One is you need to understand the drivers of the financial statement lines. To do this, you need to understand the individual financial statement lines as well. And then what basically, because I can't really, because of the sake of time, it's just about 14 minutes left, right? But the key principle in forecasting is, I mean, given we've done extensive company and industry analysis, what you need to do is, and I'm happy you guys did FSA yesterday, is you need to take each of the lines of the business, right? So the revenue line, the cost line, direct cost, the administrative cost, the employee cost, finance cost, and all that. So you take it individually, and then you then forecast this based on past trends majorly, right, over time. But to know this, there are primary rules at which you can use after you've identified each of these lines, right? A way to forecast it is by one, you can either use historical rates, right, to understand how have they performed over the last 5 or 10 years, and use these rates to project the next 5 to 10 years. That's one thing you can do. The second thing you can do is use the industry rates to grow the business over a certain period of time, assuming that the business will not grow faster than the industry. After this, you can also speak with management. Maybe based on some certain developments, management believe that they'll be able to grow or perform better than what they've done historically. And then you apply that rate over the forecast period, which is using the guidance of management. And lastly, you can perform your own analysis, right? Or use other analysis reports, right, that you derive from popular sources such as Bloomberg, S&P, FactSet, etc., right? So then use to estimate the performance of that business over the certain period of time. So this should be done for each individual single line of the business, right? So from revenue, right, either you do a top-down or a bottoms-up approach for your operating expenses as well. So for your cost of goods sold, your selling expenses, general expenses, administrative expenses as well, right? You need to do this as well. Then also for your balance sheet, you need to forecast the working capital of the business, right? And lastly, you need to also do this based on this similar line. So either you use the historical performance, understanding of working capital, you speak to management, understand the guidance from management, you use the industry working capital applicable rates, or you use discretionary analysis reports, so FactSet, Bloomberg, etc., right, to then forecast the working capital. Lastly, what is extremely important in when you are doing a forecasting for a company is you must perform a scenario analysis, right? A scenario analysis is very important. It's very important that you perform a scenario analysis, meaning that, say for instance, for folks that build models, when you are forecasting, don't forecast a single scenario. Try to forecast a worst case scenario, forecast a base case scenario, and forecast a best case scenario, right? At the minimum, that's a standard practice. So forecast different scenarios, right? At which the different numbers to sort of turn out. That is what is typically done in practice. And then this helps with decision making as well. So we're almost done. So the very last topic within the equity investment is equity valuations methods, right? So understanding how to value an equity investment, right? And basically, there are 4 ways at least that we'll be learning in terms of how to value an equity, in terms of how to value an equity investment. One is using the discounted cash flow methods, right? Using discounted cash flow methods, that's FCFE and FCFF, right? Using the multiplier models, that's relative valuation models. So where we'll be using price to book, price to earnings, price to sales, or price to cash flow. Also valuation using the asset based approach, right, to value the business. So I will just quickly touch on this in about 5 minutes, and then I'll just use the remaining 5 minutes, to answer any questions. So for the very first approach, right, in terms of performing an equity valuation, right, is to perform the valuation by doing a present value of, sorry, there are 3 major methods. I said 4. So it's either the present value method, which is estimating the free cash flow and then discounting it, the multiplier method or the relative valuation method, or the asset-based method. These are the 3 main methods, right? So the very first one, as I said, is the present value method or the discounted cash flow method. So under this, it's broken down into 2 mainly, which is the DDM, I would say three, right? It's broken down into the dividend discounted cash flow method, one, the free cash flow to equity model, and which is two, and three, free cash flow to the firm model. For the DDM model, what you'll be doing with the DDM model is you would be estimating the future dividends of the business, right? And after you've estimated the future dividends of the business, you'll be applying a discount factor, then discount that future dividends to the present value, at which you then use that to arrive at the present value of all the cash flow. So if you are, say for instance, it's a public investment, right, and where you don't expect to earn return from capital gains, right, mainly from dividends, right? So you need to estimate all the dividends and then discount that to the present value, right? Another method under this discounted cash flow is FCFE and FCFF, which you choose which to apply in practice. So for FCFE, what you are doing is you are measuring, you are going to estimate the FCFE of the business, and you must have done this under FSA, right? To estimate the FCFE of the business, typically over 5 years or 10 years, and then you discount that FCFE to the present value, right? So FCFE meaning your cash flow from operations minus cash flow minus investing cash flows and your net borrowings, right? And then once you do this, you arrive at your equity value, right? The next step is to apply your FCFF, right? So your FCFF means that you're estimating the free cash flow to the firm. So once you estimate your free cash flow to the firm, your free cash flow to the firm is cash flow from operations that directly plus minus your investment cash flows, right? So you're not subtracting your cash flow from financing, right? So once you do this, you're arriving at your enterprise valuation. And once you arrive at your enterprise valuation, you then deduct your net debt to arrive at your equity valuation. So basically with this way, you then arrive at the equity value under the FCFF model. Again, I'll just recap. So for the free cash flow to the firm, for the discounted cash flow model, which is the number one way of performing your equity valuation, there are three methods under the discounted cash flow. Either you use your DDM, your free cash flow to equity, or your free cash flow to the firm. The next valuation method after the discounted cash flow method is the multiplier model, right? For the multiplier model, what you're doing is you're applying a multiple to the fundamental of the business. So you either use, you can use the price multiple, which is what is done mostly in practice, or you can use an enterprise value multiple. So the major multiples used in application typically are the price to earnings multiple, price to book value multiple, price to sales multiple, and price to cash flow ratio as well. So you typically get these ratios from public sources or from paid research materials like S&P Capital IQ, Bloomberg, etc. And then you apply this multiple to the fundamental of the business and then use this to determine the value of the business. This is the second method, right? And then lastly, the last method is to perform an asset-based valuation. For an asset-based valuation, what you are simply doing is you are trying to determine the value of the business based on the current book value of that business as of the time of the valuation, which means that basically you are looking at the value, say for example, you're going to understand what are the value of the assets. So you start by looking at all the assets of the business, right from the properties that the business own, the equipment the business own, other intangible assets that the business own. Also, you look at the cash balance of the business, as well as the inventory of the business, and maybe money is expecting to receive from people that are owning the business. You add all this up as the assets of the business, right? And then you then go back and then you look at what are the value of the liabilities of the business as of today. So the people the business is owing, you take that out, whether it's short-term debt or long-term debt, right? You add all of the liabilities up, you subtract these liabilities from the assets, and then based on that, your total assets minus your total liabilities, you then arrive at the equity value of the business. So again, these are the three ways you can value a business. To recap, number one is the discounted cash flow method, where you can either apply a dividend discount model, a free cash flow to equity model, or a free cash flow to the firm model. The second approach you can use is the relative valuation method or the multiplier method. Typically, what is done here is price to earnings, price to book, price to sales for price multiples. So you get the multiple and you apply that multiple on the fundamental of the business to arrive at the value of the business. There are also enterprise value multiples that are used in practice. Things like enterprise value to EBITDA, enterprise value to sales, etc. Right. And then lastly, there's the asset-based valuation, where you determine the total assets of the business, subtract this from the total liabilities, and then you use this to arrive at the equity value of the business. So these are the three primary approaches. So with this, we've come to the end of the class. I will now just look through the charts to take one or two questions. Again, I might not be able to take a lot of questions. So if the facilitators follow up, I'll be happy to put together, as I said, that 50-page summary material and share with you guys, so that can serve as a summary crash notes that you can use to quickly use for your revision, maybe a week or a couple of days before your exams. Again, all the best with your exams. I'm sure you guys will do great. Thank you to the facilitators for having me on here. It's been a pleasure. So I'll just now look through the questions to take a bit. I know it's just 2 minutes, so I might be logged off. So I'm just going to quickly look through the questions to see if there are any questions that I can take. Okay, so it seems there are no major questions. I think the questions are largely on the slide. So I'll be sharing this one I just presented. But again, this is just a 10-page. What I just presented is just a 10-page. It's just a 10-page slide, right? So it's an extremely high-level summary. It might not do justice to the 800 pages you are expected to study. So if your facilitators follow up, I'll share this immediately. But then your facilitators follow up, I'll share a 50 pages document as well that will help with the crash revision. Thank you. Jessica, Bukola.
Yes, I'm right here, sir. Thank you so much. I can see participants in the comment section saying thank you as well. Thank you for having this session with us. Thank you. Thank you. Please, guys, no log off yet. We are going straight to the second session right about now. Our second facilitator is with us in the person of Irene Onyeke, CFA. Should we begin her session in 1 minute? So please stay put. If you need to, drink water, please drink water. We'll be starting right about now. Thank you so much. Irene, if you can hear me, I'm making you a co-host now so that you can start your session, please. Thank you.
Yes, Jessica. Hi, I can hear you.
Thank you so much for joining us.
Thank
you can go on now.
Can you see my slides?
Yes, I can.
Okay. Please let me know when I can start.
You can start now. It's 2 p.m. already.
Oh, okay. So, good
sorry, before
afternoon.
you go on, you go on, let me answer a question. Break will come at 3, please. 3 p.m. to 3:15. If you check your timetable, you will see that, please. Thank you so much. Please, you can go on now.
Okay, so I'm expecting the questions will come after the presentation. Is that the modality?
Yes, please.
Okay, thank you. So good afternoon, everyone, or good morning, good afternoon, wherever you signed on from. So my name is Irene Onyeke. I'm going to be taking us derivatives, actually the first 4 readings of derivatives for the next 1 hour. Because we don't have enough time, I'm going to be a bit fast. However, I'll slow down whenever I feel I'm too fast. So like I mentioned earlier, I'm going to be taking the first 4 modules in the derivatives and some other things I picked from other modules, yeah. So I'm going to be looking at the derivative instruments and derivative markets, forward commitments and contingent claims, derivative benefits, risk issuer, and arbitrage replication, cost of carry in pricing. So we've been reading for a while now, so I know some of these things are a bit basic to you, but it's going to form a foundation into what we are doing. So when you talk about derivative instruments and derivative markets, so what are those instruments? Instruments are basically the backbone of what you are doing in derivatives, yeah? So the instruments are the forwards, futures, swaps, credit derivatives, and options, yeah? And these instruments are actually traded within some markets, and these markets are the OTC, over-the-counter markets, and exchange-traded markets. We are going to be looking at this, the difference between the over-the-counter and exchange-traded, because we are required to know that. In this reading 66, CFA Institute actually wants you to be able to define derivatives and describe basic features of derivative instruments that I mentioned earlier. You are expected to also describe basic features of derivative markets, which is the OTC and the exchange-traded markets, and compare and contrast the OTC and exchange-traded derivative markets. Simple, right? So starting with what derivative is, a derivative, basically, it's a financial instrument that derives its value from the performance of an underlying. So the underlying could be equities, it could be bonds, it could be weather, it could be credits, like the default risk of another person, yeah? So it could be inflation, it could be currency, performance of a currency. What this means is that the value of derivative actually depend on the performance of these underlyings, depending on the underlying you are using for your contract. So on a standalone, derivative does not have its own value. So it derives its value from the performance of the underlying. So the strategy I'm going to be taking is I'll have like a bit recap of the reading and would solve some questions, yeah? So derivative market is future market, is not transaction for now, it's not spot market, it's not cash market. So it's market where you enter into a contract now, but the delivery is in future, yeah? The delivery, whether physical or not, is going to be in future, not today. So you can also be asked to compare the future markets with the spot market. Spot market, as the case may be, is what we are buying and selling. If we go to, let's say, exchange now, you see equities, you see bonds, they are cash markets, you buy and pay and go. But for derivatives, is for future, so it is settled in future. The delivery is taken in future. So another LOS says we should be able to describe basic features of a derivative instrument. What differentiates derivative instruments from the ordinary instruments we have in the markets, like equities, bonds, commodities like gold, is that, like I mentioned earlier, the value of the derivative depends on the performance of an underlying. And there's an implicit leverage. What do we mean by implicit leverage? So if you have, let's say, if you have small amounts of money, you are able to gain exposure into a large amount of notional principal, yeah? So you can pay your premium and get an option of even $1 million, and you pay premium of, let's say, $20,000 or $20, something like that, depending on the contract. So there is an implicit leverage in it. You use small amounts of money to gain exposure into a higher amount. That is what is meant by implicit leverage. This derivative instrument is basically used for hedging, speculation, and arbitrage. Arbitrage, where you take advantage of mispricing, yeah? Speculation, we do that a lot. So where you speculate that, let's say, dollar is going to be this amount in future, let me buy dollar now, let me buy dollar in future. So if you expect dollar to depreciate, so what do? You can short dollar in future, so you sell forward you sell your dollar forward, because at that future time, the dollar will be, the dollar will depreciate, yeah? So also hedging, you can use it to hedge your exposure, risk exposure. If you have, let's say, if you have an exposure in your portfolio, for instance, you have a fixed debts, or you have a fixed debt instrument in your portfolio, yeah? So, and you feel that in future, the prices, let's say interest rate swap, the interest rate is going to be lower. What do? You can actually convert that to floating, where you want to be paying a lower interest rate compared to the fixed, which you have earlier entered. However, there's a problem with derivative. The issue is that it comes with its own risk. So there could be credit risk mainly for OTC market. So credit risk, how is this person going to actually perform or not? Liquidity risk, finding it difficult to enter and exit markets, especially also for OTC markets. And market risk, because it derives its value from the performance of an underlying. So as the prices of those underlying are changing, especially when it's not favorable, it's going to be affecting the value of a derivative instrument. So also settlements can be done physically or cash. So most times it's cash settled. We don't want to take delivery of whatever derivative instruments you are using, or whatever derivative underlying you are using. So also derivatives are marked to market. For exchange traded derivatives, they are marked to market on daily basis to determine who has exposure and what exposure the person has. Yes, we are going to be looking at exchange traded derivative markets, yeah. So, and there is also an expiration. So it's not open-ended. There is a maturity period. You can say for 90 days, you can buy a derivative instrument for 120 days, 160 days, etc. So also, the LOS expects you to be able to compare the OTC markets and exchange traded markets. So the OTC markets are over-the-counter markets where instrument contracts are customized, so it's bespoke, so you can customize it to fit what your transaction, yeah? So if you have an exposure for 90 days, for instance, and you want to be able to hedge that your 90 days exposure, you can, instead of going to exchange traded, which you might not see exactly 90 days hedging instruments, you can go into OTC transaction where you can adjust, or you can pick, you can agree with the counterparty, the opposite counterparty, the tenure of that contract, yeah? So OTC markets are customizable. They are less liquid because, like, private things that are private, like, it's difficult for you to find a buyer and seller. So to enter and exit is a bit difficult compared to exchange traded, which is markets transparent. Everybody sees what is happening in the floor. Yeah, so, and it's less transparent because it's between two parties, unlike the exchange traded that has exchange as intermediary between the users and financial intermediaries. So the trading cost is also higher. Why is the trading cost higher? Because the cost of even finding a second person that you are going to enter the transaction with will be a bit higher compared to if it's exchange traded derivative. You just go to exchange and you're able to see those securities listed on the exchange, and you enter into, you buy as the case may be. So there is also the existence of credit risk in over-the-counter derivatives. Why? Because it's private, so it's between two parties. So the second party might decide not to honor the obligation, especially when it's unfavorable to the second party, yeah? So examples of OTC market derivatives are forwards, swaps, and options. So these are typically OTC derivatives, but of recent, a lot of swaps, forwards are being traded in exchange traded markets. However, if question asks you, typically forward, swap, what type of derivative is typically OTC derivative, except if mentioned, the answer is OTC derivatives. So for exchange traded derivative, they are standardized so as to the amount, the time, as specified, so you don't adjust it to suit your own situation at all, unlike OTC. So more transparent, there is a presence of central clearing that clears and settles transactions. However, for this to happen, there should be a collateral deposit from both parties, which is known as margin. Yeah, initial margin, you deposit initial margin depending on the contract, and you are able to net off on daily basis. So that takes me to the next one, which is mark to market. On daily basis, you net this to see who is losing and who is gaining, credit who is gaining and debit who is losing. Example of exchange traded derivative is futures. So looking at the derivative markets, let's look at these questions. I don't know, how are they going to be answering it? Are they going to be saying it out loud or typing it?
Ma, they can type in the chat box.
So I can't see the chat box. So can you tell me when they finished?
Okay.
Okay, I can see. Okay, that's fine. Let me see. Okay, so let's start with this. I can see it now. So
Okay,
which of the following, sorry. So which of the following statements most accurately describes a derivative security? So a derivative security, is it A, always increases risk, B, or C? So anybody? Am I seeing any? I'm not seeing any response. Okay, C.
Okay,
Yeah, thank you.
Okay.
Thank you very much. So a derivative actually might increase risk, but it's not always increasing risk. And it has, like we saw earlier, it has an expiration date, which is the maturity. Also, it has a payoff based on an asset value or the interest rate. Sorry. What did you say is the answer? C. No way. Everybody C. Thank you. So the most accurate thing is that a derivative has a payoff based on an asset value or interest rate. So you can't say it doesn't have expiration date. You can't say it increases risk. The second one, which of the following statements about exchange traded derivative is not accurate? Is exchange traded derivative liquid, standardized, or it carries a significant default risk? Let me see. I've seen so many C's. Is this C for the second question? Yes, if it's for the second question, then yes, it's correct. So exchange traded derivatives, what? Exchange traded derivatives does not carry significant default risk. It's OTC derivative that has significant default risk. Exchange traded derivatives are typically liquid and standardized, so they are not bespoke. The next one, which of the following is least likely an OTC derivative? So the person that wrote futures, thank you, because the ABC is a bit confusing for me. So futures is not, remember when you are answering question, always watch out for this, least likely. So futures is not an OTC derivative. Forward contracts, sorry, there's a repetition here. Forward contracts, options, and swaps are OTC derivatives. So the next one is, if a corporate issuer enters into a centrally cleared OTC contract, which of the following risk is likely of most concern to the issuer and other participants in the market? So okay, so I'm seeing B here. Yeah, I wouldn't blame, yes, systemic risk. The person that answers systemic risk is correct. I wouldn't blame you because we haven't really discussed this. So in exchange traded derivative markets, so what happens, there is a concept known as novation, yeah? Novation is a situation where the exchange takes opposite side of each of the trades. So if a long buys a forward, for instance, exchange will be the party, the opposite party will be the short for that person, for the participants. If somebody goes into short forward, exchange will be the long. So because they do all this, they take the credit risk away from individuals. The participants like the dealers and investors, yeah? So if they take all these credit risks, as they are assuming these credit risks, at some point they might run into an issue where a situation that can lead to systemic risk that will affect the whole market, yeah? So exchange will be assuming the credit risk of all the participants and the markets. At some point, they might run into troubles, and even the credit risk they are protecting, it will now lead to the systemic risk in the market. So if we have a corporate issuer that enters into a centrally cleared, remember I said OTC transactions like swaps, forwards can be centrally cleared. So if you elect to clear your or to do your own transaction centrally, means you are going to be introducing the exchange traded exchange into your transaction, and by so doing, your worry will not be counterparty risk anymore, because exchange will assume this counterparty risk. The worry will now be systemic risk, whereby the exchange will run into a problem that can lead to a trickle-down effect to the whole market. Is it clear? Thank you. Then let's continue with the second model, which is forward commitments and contingent claim features and instruments. So these are the things that we expected to know. We expected to be able to define forward contracts, futures contracts, swaps, options, credit derivatives, and compare their basic characteristics. We also expected to know the value and payoff of a long and short call and put. This is clearly stated. So you need to know the value or payoff. So value is also payoff. The payoff and the profit of call option and put option, yeah? And should be able to contrast forward commitments with contingent claims. We had earlier identified those instruments. Have we? Okay, no, we're identifying them here. So firm commitment, it can be called forward or firm commitment, yeah? Firm commitment versus the contingent claim. So some of these instruments we had earlier identified are classified into either firm commitment or contingent claim. And CFA institutes actually want you to be able to identify those instruments and differentiate them. Yeah. So for firm commitment is just saying that both parties have the obligation. Once you enter into this transaction, whether it's futures, forwards, or swaps, you have the obligation to exercise. You have the obligation to perform according to the agreement you have had with the party. Yeah. So there is no event, it's not determined, the performance of that instrument is not determined by any event happening. So example of these forward commitments are futures, forwards, and swaps. Remember, I said it can be called firm commitments or forwards. By the name commitments, you already know what it's talking about. You have committed to perform, to honor the transaction, they honor the agreements that both of you or the parties entered into. However, for contingent claim, the examples are options and credit derivatives. And they are called contingent claims because the performance of these contracts is contingent upon an event happening. So for options, it's contingent on the long exercising, whether long call or long put. So it's only when the long exercises that the short side of the party will now either sell or buy from the long. Yeah. So for credit derivatives is basically derivative that has credit default risk as an underlying. So it is contingent claim because it's only exercised when event happens. What is that event? When there is a default. So we are going to see what credit derivative is, but as a summary, a way of summary, credit derivative is simply a situation where you are exposed to the default risk of somebody. It could be an issuer. An issuer issues shares, for instance, and you bought those issues bond, for instance, and you bought those bonds. At some point in time, you are worried that that issuer might not be able to pay you back your money. What do? You can approach a protection seller or an insurance company, protection seller, to sell protection to you, and you buy this protection, you pay the protection seller premium, buy protection. What happens is that at the time you could not get your money, there is a default from the issuer that issued the bonds, you can refer to the protection seller to make you whole. The protection seller gives you based on what's agreed upon rates. Yeah. So the protection seller makes you whole while you are losing from the other side. So you are not able to recover your funds from the forward contracts, from the bonds that you bought, but you have been able to cover your risk by buying protection from an insurer, typically an insurance company. So this is why they are called contingent claim. It's contingent upon events happening. For option is when the long exercises. For credit derivative is when events of default happens. So, and remember, for options, option holder, which is the long, can only exercise when it's favorable to him or her. Yeah, it's only when it's favorable to the party that the person can exercise. It's favorable for call when the stock price in the market is greater than the exercise price. That is the fixed price they have agreed that he is going to be buying it. So if they are selling it 1,000 in the market and he had agreed with you earlier that he's going to buy 900, you see, favors him, he can exercise. But the put is the other way around. We are going to be discussing that one after the other. So looking at the instruments, called derivative instruments, the first one we have is the forward contract, and you're expected to know the definition. So basically, we have identified earlier that it is an OTC derivative, and it's a derivative that is between two parties. So this is why it's an OTC, yeah? So it's between two parties, a buyer and a seller. So the buyer who is long and the seller who is short. So the buyer will have agreed to buy the underlying from the seller in a future date at an agreed upon fixed price. Yeah, this forward price determined today at the termination date is the So within forward contracts, in each of the instruments, we have long and short position. So for forward contracts, we also have long forward and short forward. So you are long an instrument when you are buying the instrument. You have the right to buy the instrument. And you are short instruments when you are selling the instruments. Yeah. So for a long forward contract, you expected to know the payoff. You expected to know the payoff, and the payoff is ST, which is the stock price at maturity, minus the fixed price that you agreed today that at maturity, this is what you are going to be buying from the seller. Yeah. So this is the payoff. You need to know how to compute the payoff. And for every long benefits when the price increases, when the stock price increases. Why? If we have, for instance, a position of, if we have agreed that you are going to be buying from the short at, let's say, $90, and the time we agreed the SO was, let's say, $80. At the time of maturity, stock price moved to $100. Sorry. Stock price moved to $100. You can see you have a payoff of 10. Yeah, you have a payoff of 10 already. At this point, you can agree to exercise. You can decide to exercise. Sorry, you'll be gaining. If you value your transaction at that time, you will be gaining 10. You have a payoff of 10. Yeah. For the short forward contract, who is the seller, the payoff is the opposite of the long. So the payoff is, for this place, is a zero-sum game. If you are using the same example, if the long has a positive payoff of 10, the short has a negative payoff of 10, because it's the short that is selling to the long. So the short benefits when the price appreciates. So if the price appreciates, the short is going to be losing. Please take note of this. Aside the computation, some of the things CFA Institute also has some of these key things to understand, to know whether you understand the concepts. Yeah, so it's not just calculation. Maybe you crammed the formulas and you're able to fix the numbers. So you should be able to apply those computations. So this long benefits when the price increases, because you can see stock price is here before the fixed price, and the short benefits when the price go down. For futures contract is standardized. It's same as forward contract, but it's standardized. So it's standardized forward contract. The difference is that it trades on the exchange and is marked to market on daily basis to determine who has exposure of what. So there is also the concept of initial margin. What happens is when two parties want to enter into a contract, so the exchange determines, already published, the initial margin which both of them need to, the deposit which both of them need to put in their account, margin account. And if they deposit this, it is the initial margin. As time passes, they will be determining mark to market value. So it could be positive. For the person that has positive, they will debit the other party and credit the person that has positive. If you have negative, they will debit you, credit the positive. If you have positive, you receive money. So if you have money in your initial margin and it goes down below the maintenance margin, so they can say the initial margin, as you're entering a transaction, you need to pay $50,000, for instance, $50,000 to be able to enter into this transaction. It's a collateral and not the cash. Is not like initial, I don't know how to put it, unlike the premium you have to pay to somebody. So this money is not going to any of the parties. It's just a collateral. Yeah, to reduce the risk, the credit risk assumed by the exchange. Yeah. So if the initial margin is 50 and at some point your margin account goes down to 40, let's say the maintenance margin is set at 40 and your margin account go down to 35, for instance. So you receive a margin call. The margin call is just saying top up your margin account. So if you receive a margin call, the difference between what you have now is what you need to top up. Sorry, this is the margin, this is the maintenance margin. Okay, so this is what you have now. So difference between this 50 and 35, which is 15, is your variation margin. So this is the amount you need to put in your margin account to return back to the initial margin. Take note, you don't take it back to the maintenance margin when there's a drop down. When it goes below maintenance margin, you take it back to the initial margin and not the maintenance margin. The payoff for forwards is this, for futures is same as payoff for forwards. So I brought in this. So sometimes CFA institutes can actually give you diagrams and ask you to identify what that is. So if you don't know your diagrams, you might maybe be struggling. So the easiest way to know that is, this is long forward, yeah? So long forward, if you see this, the line is straightforward because forwards has linear payoff. Linear payoff simply means that the value you get from it is not dependent on any event happening. So if the stock price increases by 50, for instance, and increases by 50, the difference between the stock price and the agreed upon price is 50, for instance, your payoff is 50. So there's no premium reducing it. There's no event happening before you can get that money. So you see a straight line. When you see a straight line, you know that is a forward diagram. Yeah, so this is long. For short, you are going to be seeing the diagram coming downward sloping, unlike the long that will be upward sloping. This is the fixed rate. You can see is fixed. So between this place and here, and the fixed rate and the stock price at maturity, if the stock price at maturity is greater than the fixed rate, you know, we say the long benefits. This person here, long year profits. Yeah, but between here and here now, the long loses. Why? Because the stock price is less than, you can see stock price is here, is less than the forward price agreed upon today. So moving forward, we have also swap contracts. Swap contracts are basically series of forward contracts. Yeah. So we have two parties. One leg is the floating, could be the floating leg, or the second one, which resets periodically. The second one will be the fixed leg. So the fixed leg is typically referred to as swap rates, while the floating rates can be determined by market reference rates. The market reference rate, before now, we used to say LIBOR, yeah, for foreign transactions, but now we have SOFR, we have SONIA, we have all those reference rates. And of recent in Nigeria, we also introduced overnight rates. So these are basically rates that changes. They are not fixed throughout the tenure. So swap contracts, the most common swap contracts we have is interest rate swap, whereby one party will be exchanging fixed rate interest rates with the other party who is giving the person a floating interest rate. The similarity swap has with futures and forwards is that no money is exchanged at initiation. So nobody gives anybody money. At initiation, the value of a swap contract is 0. Why is this 0? Because the PV of the leg is equal to the PV of the floating leg is equal to the PV of the fixed leg. Yeah. But as time passes and they mark this transaction to market, the value of a swap contract actually changes. So it can change and favor the fixed leg. It can change and favor the floating leg, depending on the movements in the market. Yeah. So if in that case now, if you are computing the value and is received fixed, for instance, if it's received fixed, pay floating, so it's going to be, let's say receive fixed is 20, and pay floating is 30. So it's going to be, since you are receiving 20, it will be 20 minus 30. 30 is going out, so you are losing. This receive fixed is losing and the other party is gaining. Yeah, so that's basically how swap contracts are valued. You need to know that at initiation, the value of a swap contract is 0, and it's typically 2 legs, one floating and the other one fixed. Also know that fixed rates can also be called swap rates. So for credit derivative contracts, the credit risk is the underlying. Unlike other instruments, we can have equities, bonds, and etc. Here, the default risk is actually the underlying. The most common credit derivative contract is CDS, which is credit default swap. So credit default swap is a financial instrument that allows one party to transfer the the credit risk of an underlying to the other party. I had earlier given an example. Yeah, so it's a contingent claim. So it's not forward commitment, it's contingent claim because the timing and the amount of cash flow is not known. Yeah, so the time that there is going to be a default is not known to both parties, and even the amount is also not known to both parties. So CDS spread is based on credit spread. Credit spread is what the agreed credit spread is what the counterparty, the protection buyer, is paying to the protection seller as premium periodically. Most times in reality, in a practical, it's done quarterly. Yeah, so it's what credit spread is what protection buyer pays to the protection seller in order to get protection from the protection seller. So why CDS spread is the premium paid by the buyer to the seller. When risk actually crystallizes, when there is a default, the seller pays the buyer issuer loss given default times the notional amount. So the notional amount, if it's 100 million, loss given there is a default at the time of default event, how much were lost. So assuming now your exposure was 100 and you're able to recover 50, for instance, you know what we are going to be calculating is 50 as a rate. You convert it as the rate, usually as a rate multiplied by the notional principal. Yeah, and that is what the protection seller is going to be paying to the protection buyer. However, through the life of that credit derivative contract, the protection buyer will be paying periodic CDS spread, agreed CDS spread to the protection seller. So the protection buyer, who is the counterparty that is exposed to an initial credit default, yeah, is short risk because he has sold his or her risk to an insurance company, for instance. So he is said to be short risk, credit risk, and the protection seller who is selling this protection to the protection buyer is long risk because it's buying off the event, the default risk from the counterparty. So options, it's also important you pay attention to options. Questions can come in any form because there are so many small things within options that they can easily write questions from. So option basis, just like we have long and short forward, in options, we also have long and short options. And we have call options and we have put options. So call options give the holder the right to buy an underlying at a particular rate. By rate, I mean price, and at a pre-agreed time. Yeah. So, but the put option gives the holder the right to sell an underlying. So right and not obligation from the long perspective, whether long call or long put, the long has the right to either buy or sell, but the short has the obligation. Once long say he wants to exercise, the short must sell if he's selling that the short is doing, or must buy if he's buying that the short is doing. I don't know if this is clear. So you can also say that an option seller is a writer of an option. So you can see in the question, writer or seller or short, whichever one is the same thing. And an option buyer is either long an owner or an owner of an option. You are long, you own it, you own an option. So you have the right to buy at a strike price, you agreed on the price. And for put option, you have the right to sell. So there is also a concept of European and American option. So it could be European call option, European put option, American call option, or American put option. So like everything in America, American options are flexible. So it can be exercised anytime before the maturity date. But while the European options can only be exercised on the date agreed. So in that case, between these, because this has flexibility, the premium that this one will be paying will be higher because you can exercise anytime within the life of the contracts. But for this, you must wait. Even when you are seeing that it's favoring you in the market, you have to wait till it matures. So going forward, so we have long forward option. So for, like I said earlier, long option gives the holder the right to buy an underlying in future at an agreed date and strike price. So the long has the right but not the obligation to buy. And you're expected to know the payoff and the profits of both call option and put option. The payoff is also known as the intrinsic value. So the payoff of a call option is maximum of 0 ST minus X. So maximum of 0, it cannot be negative. This is basically saying that the payoff to a long call option cannot be negative. Why can't it be negative? Because of this, you can see maximum of 0. If we have, let's say ST is 10 and X is, let's say 12. So you see, you'll be tempted to say the payoff is -2. However, payoff of a long call option can never be negative because of this maximum of 0. So you can neither take 0 or, so the answer here will not be -2, it will be 0. However, the profits can be negative, of profit or loss. Yeah, so negative can come in. So the profit will now be the payoff minus the premium. So for call option, premium is represented as CO. Yeah, so it's the payoff minus premium. The example we gave earlier, if this -2 is actually profit, then you can represent it as -2. But if it's payoff that you are looking for, -2, it cannot be negative, it has to be 0. So payoff for long is always 0 or is always 0 and not negative, because a long will only exercise if payoff is not negative. So if it's not favoring him or her, he cannot exercise. The only time this long party can exercise if ST is greater than the agreed upon price. They have agreed that at the end of the month, for instance, he's going to be buying Apple shares from you at $30. So come rain, come sunshine, it's $30 that is going to pay. So if this Apple shares go up to $50, the long we want to exercise because he wants to benefit. He has a payoff of 20. Yeah, but if the stock price go down to, let's say 25, it's not benefiting him. So why will he assume loss? So he will just leave the option to expire worthless. So for the short call option, short call options has obligation to sell at strike price. So the long has taken a position, the short must exercise whenever the long wants to exercise. The payoff for the short call option is the opposite of, just like we saw in our forwards, is the opposite of the payoff for the long call option. So it's minus maximum of 0 ST minus X. So if you have minus minus here, you can see that it's nailing off this. So whatever thing, if the long has a profit of -2, then the short has a gain of 2, and vice versa. So for profit is the same thing. So I'm sorry, let me remove this. This is minus. So this is minus maximum of 0 ST minus X minus CO. Oh, sorry. It's plus. This is plus. It's short that we're talking about. So this is plus. Why is it plus? Because the short is receiving premium, while the long is paying premium. The short is the one receiving. So this is why this is minus. This is reducing his payoff, and for this person is increasing because it's the short that is receiving that premium. So call option seller faces unlimited potential loss as underlying price appreciates. So to start with, the long has the maximum profit of a long is unlimited. Why do you think it's unlimited? Because stock price theoretically can go into infinity. So as the stock price is increasing, it's also benefiting. But for the short, has unlimited, the opposite, unlimited loss, because as the stock price is also going down, this is also losing. Yeah, the maximum gain for the person who has received premium is the premium he has received, because the long will exercise when it's benefiting him, when it's benefiting the party long, not when it's benefiting the short. Then for put option is the right to sell, gives the holder the right to sell an underlying in future at an agreed price and strike price. So the right to sell. So for long put option, the payoff is maximum of 0 X. Instead of ST starting is X minus, that's the exercise price minus ST. And the profit is payoff minus the premium. So for long, the maximum loss is actually the premium paid. Once he pays the premium, that is the maximum loss, because he is not going to exercise when it's not favoring him. So the same thing with this for the call option. So for short put option, the payoff is the opposite side of this, minus maximum of 0 X minus ST, and the profit is plus payoff plus PO, because this party is receiving the premium. Put option seller's loss is limited because underlying price cannot fall below 0. No matter how it goes down, it cannot do -1 or minus anything. So this diagram, I brought this diagram here, like I mentioned, it's good for you to also master your diagram, because questions can just draw diagram and say you should name the diagram. So you can see this side, we have the call option, we have long call option, we have short call option. What is the differentiating factor? If you have just a plain diagram here, of course, they will not give you these names in the exam. It's left for you to label. How do you know which one is long and which one is short? If you look at this, remember we said the long the long pays the premium to short. You can see we have minus CO here, which shows that the premium is going out. CO is the premium. Premium is going out, and it reduces the party's profits. Yeah, and for here, the premium is positive because the premium is coming into the short counterparty. For S plus CO is the break-even point. The same S plus CO is break-even point for this. So we're at the point where he has recovered the exercise price and the premium paid is the break-even. So the question now is, why do they have the same break-even price? Actually, it's the same break-even price. However, the interpretation is different for them. For long payoff, for long call option, once the stock price goes above the break-even point, it starts making gain. Yeah, it starts making gain. But for the short call, once the stock price goes above the exercise price, it's the break-even point, it will start making loss. The short counterparty will start making loss. You can see that here. So for the put option also, you can see the put option. This one is long because premium is going out. Here, oh, this one is short forward. We had earlier seen short forward diagram. I didn't put the short put, but for the short put, you see positive. The PO will now be here because it's receiving premium. So the summary of options, it's good to know. For long call option, it gives you the right and not obligation to buy at exercise price. And the payoff is that the long benefits when this ST is going up. The long has limited loss because once he pays his premium, that's the maximum loss he can lose. And unlimited gain because stock price theoretically can go to infinity, meaning that is when the long has bullish market view. Bullish market view is saying that the stock price is going to be increasing. That is when you want to enter into a long transaction. For the opposite party, which is short, has the obligation to sell at this agreed upon exercise price and loses when the stock price is increasing. It has limited gain and unlimited loss. So as the stock price is going down, the potential loss is unlimited. So the short counterparty will enter into this transaction when he has a bearish or neutral view, meaning that he expects the stock price to either go down or at least remain where it is. For long puts, it gains when the stock price go down. Why? Because remember the formula is X minus XT, which means as stock price is going down, this X will be greater than ST and the long puts will benefit. For short puts, the short puts will lose when the stock price is going down. It has limited gain for short puts and limited loss for long puts. So this is okay, it's good for you to understand this. So somebody counterparty entering long puts will do that when he expects the market price to go down because he actually benefits when market price is going down, and opposite is the case for short puts. So let's look at questions on forward commitments and contingent claims. So if you can see this, can you solve this question? We are running out of time. So basically, because we don't have time again, so this is saying which of the following represents a payoff and profit of this strategy? What is the strategy? It wants to increase his equity exposure using call option. So the payoff for call option is ST maximum of X, maximum of 0, ST minus X, and ST here is what? ST is 16, so 16,000 minus, and the time of expiration is now, sorry, ST is 16,500 and X, they agreed that is going to pay 16,000. So the payoff is 500. However, the profit is 500 minus 1,500. That is 500 minus 1,500, which is minus 1,000. So for this is A. Is that clear? I can't see the charts. Okay, thank you, Flourish. Then we'll go to the next question. Which type of contracts always require daily marking to market? So which of them? So futures always requires daily marking to market. These ones, the forward is only if it's centrally, they agree that the transaction will be centrally cleared. To avoid closing out a futures position, when a trader's margin on a futures position falls below maintenance margin requirements, what happens? Is it adding additional margin must be deposited to bring the account up to maintenance requirements, or additional margin must be deposited to bring the account up to the initial margin level, or the trader's margin loan is increased in size? Which of them? So it has to be brought back to initial margin level. So if your initial margin account goes down up to maintenance or falls below maintenance margin, you receive a margin call, and at that point you need to top up, need to pay in additional money to return it back to the initial margin level. So this question, it's a Bay White client currently owns his long common non-dividend paying shares of Vivu, a digital media company. The spot price of that share is $173. The client enters into a forward commitment to sell half of its Vivu position in 6 months at this. Which of the following market events most likely to result in the greatest gain in Vivu forward contracts from the client's perspective? So the client is short forward. So when will the client gain? Is it when there is increase in risk-free rate, or when there is a decline in spot price, Vivu spot price, or when there is a rise in Vivu stock price? At what point does a short forward benefit? Decline in spot price. Thank you. So remember, we say short benefits when stock price they go down, and long benefits when stock price go up. Which of the following statements about futures and forwards is correct? Future transactions involve a clearinghouse. The buyer of a forward contract typically posts a margin directly with the seller. So is it with the seller they post margin? Futures contracts are customized for individual buyers. Which one? A. Thank you. Future transactions involve a clearing house that clears and settle transactions. So the buyer of a forward contract does not typically post margin, and even if they post margin, is not directly to the seller. So if they post margin with it centrally clear, is posted to the exchange and not to the seller. And features are standardized and not customized. So this one, ACE enters a 10-year GBP interest rate swap. So this is a swap contract with a client in which ACE receives an initial 6 months MRR. So this is floating rate of 1.75% and pay fixed. This is receive floating and pay fixed. So there is trying to reduce duration. Remember, your fixed income, receive floating reduces duration because duration resets every period, every time payment is made. So floating resets, floating leg resets. So which of the following statements best describes the value of swap from ACE perspective 3 months after the inception? So they have entered into this transaction for him to receive floating and pay fixed at 3.10. This does not change. However, the floating at that time is 1.75. So at some point, it's going to change. So which of the following statements best describes the value of the swap from ACE perspective 3 months after the inception of the contract? Time has passed. A. ACE has a mark-to-market loss on swap because it owes a net settlement payment to its counterparty equal to 1.35%, multiplied by the notional amount. ACE has a mark-to-market gain on swap because once it makes the first known net payment to its counterparty, the remainder of the future net fixed versus floating cash flows must have a positive PV from ACE perspective, while the PV of the fixed and future cash flows was set to 0 by solving for the swap rate at inception. We do not have enough information to determine whether the swap currently has a positive or a negative value from ACE perspective following the inception. Which one is the answer? Which one is the answer? I'm seeing someone saying.
Irene,
Yes.
time is up. Please kindly round up. I know, I understand.
Oh my God.
Thank you.
Okay.
I get you.
That's
Thank
fine.
you so much. Thank
That's
you.
fine.
Please
Okay, so yeah, I will. So this is not B. We don't have sufficient information. Remember, we said in swap contract at initiation, the value is 0 because the PV of the PV for the leg, floating leg, is equal to the PV for the fixed leg. Yeah, that is at time they are entered. That is what is covered here. However, at initiation, this is the MIRR, but 3 months has passed. As time passes, it will now be who is winning, who is gaining. They need to give us the value MIRR rate after 3 months, at 3 months, to be able to compute this. And we have, if you have the MIRR like say 2%, it will now be 2 minus 3.10. And in that case, who is losing? So let me see, this pay fix is gaining and the receive is losing. So is it clear? I wish I had sufficient time. When I was preparing this, I was confused what to put and what not to put. So it's not clear. Yeah. Okay, so I said the answer, the best option here is C. Why is this C? We do not have sufficient information. In swap valuation, at initiation, the value of the swap is 0 to both parties. Why money did not exchange hands? The notional principal was not given to anybody. Is as time passes that the value will start changing and we'll start knowing, is it the fixed payer or the floating payer that is winning? In this case, they entered into this transaction, let's say day 1 or day 0, and at that day 0, MIRR was, floating rate was 1.75% and fixed rate 3.10. Fixed rate doesn't change, yeah, but floating has to change. 3 months after, they are saying we should determine the value of this swap. To know the value of this swap, they need to give us the MIRR at this date, which is at 3 months after. Yeah, so we don't have MIRR. So it's X, which is unknown number, minus 3.10%. Until we know this X, we cannot value this swap. So, is that clear now? Okay, clear now. Thank you. Unfortunately, let me see if there's anything I could rush through quickly. So this, I think you can do this. You can do this. The protection buyer and protection seller. I think you can also do this. Can you? So protection buyer benefits when the CDS spread increases. Why? Because he had paid, let's say, CDS spread of 200 and time has passed, the CDS has increased to 250. So if he's to enter this contract now, he's going to be paying 250, but he has succeeded in buying that protection for 200. So protection buyer benefits when the CDS spread increases, and the seller benefits when CDS spread go down. Is that clear? Is it clear? Let me quickly rush to another one.
I think that's
Yes.
all we can
clear.
take, actually.
Okay. Okay.
So sorry for the little
Thank
time.
you.
Thank you
Yeah,
so
it's
much.
fine.
Thank you so much. We have to go on break now, and then we'll reconvene by 3:15. Please note
Okay.
that we've been streaming the session on YouTube. So if there's anything you find confusing, you can go play the session again on YouTube at CFA Society Nigeria's page on YouTube, so that you can catch up on anything you missed. Maybe there was something she said that you did not get in the initial stage. Thank you very much, everyone. We
Thank
have
you.
break now, and we'll be convening by 3:15. Thank you so much, Irene, for taking your time to break things down to us this afternoon. I'm
Thank
sure
you. Thank you
everybody
for
learns.
listening, and I wish you all the
Thank you.
best. Yeah. Thank you. Bye.
We are professionals.